Hello everyone, welcome to this episode of the Turtle Travel Finance. My name is Contra Turtle and I'm here today in Shanghai, specifically in the Natural History Museum, where I'll show you guys the sights of Shanghai while answering a lot of the questions that you guys submitted to me through the AMA. So let's get started. So the first question is, do you have any advice for people trying to start a YouTube channel? Yeah, I think the most important thing that you gotta figure out is who is your audience, right? And what is the niche that you are focusing on, and what value you can give to this audience and this niche. So for myself, I am very clear that what I'm doing is specifically focused on Singaporeans, and of course people who are sort of living in Singapore, it might also be applicable to you. So whether you're a PR or people just staying around here just to understand what achieving financial freedom means here in Singapore. So the first thing is you have to figure out what is your audience and really just hyper target them and know what is your niche. Because if you try to do everything right, you will end up being nothing on YouTube. Now on YouTube there's like millions and millions of content creators. So what makes you so different from everybody else, right? It's a question that I ask myself whenever I upload a new video. If I come up with an idea to do a content that I feel like everybody else in Singapore has already done, right? Any of the finance influencers, right? Then I will just skip the topic altogether. So actually there's a lot of times when I want to do a topic but I just skip it altogether because I feel like what value am I adding, right? It's just I don't want to just add another 10 tips to set up a new broker or something like that. Like there's a lot of these resources out there already. I don't need to repeat the same content. So I think the most important thing is to find your audience and then have a niche. Yeah. And I think that another important thing is you have to start from a place of passion. So there was I don't want to say who lah, but there was a YouTuber in Singapore. I caught an interview where the person said that YouTube is a grind, and it's like it's like getting burnt out. I'm not very sure whether I agree with that, because whenever I do my videos, right, I am really passionate about everything that I do. So I want to start from a place of passion. If I don't feel like doing the video, right, I just won't do it. So I guess the frequency of my videos is not a lot. I try to do like once a week or something like that. But every video I do, right, I start with an audience of one, which is for myself. It's a topic that I'm genuinely interested in myself as a Singaporean before I actually start working on it. So I think this is really important that you start from a place of passion, and don't get burnt out, because if you do something that you're not interested in, eventually it's very hard to sustain it, especially if you're doing it apart from work, right? You kind of will find it very difficult to to push yourself. Yeah. Another really important tip I can give you all if you want to start a YouTube channel is your thumbnails, right, and the title, right, is 80% of the success. Yeah, it's quite ridiculous. So I learned this trick from Mr Beast, who is like the top YouTuber in the whole world. So I watch a lot of his videos to learn his tips lah. But I mean, I'm still very noob lah. Like, I'm still amateur lah. Like my production, everything's like shit lah. Because I also have a day job, so I don't really go like full time into this. But he said that your title and your thumbnail, right, has to have a reason for people to click into. Because otherwise, then if people don't click into your thumbnail and your video title doesn't attract people, right, then they won't even watch your video in the first place because they never click into it. Oh, what's this? Okay, all these mountain animals over here. I've never been to this museum, by the way. It's my first time, so I'm just showing you guys while I'm moving around. Yeah, so the thumbnail and title, right, is 80% of your success. And if you notice, like especially in my last 20 videos, you compare it to my first 20 videos, I would like to say that I've had some improvement lah. I really try to poke at the most controversial issues that is on Singaporeans' mind, which obviously like the HDB versus condo debate, the whole idea of investing in property versus in stocks, and the whole idea of I think there's a lot of wrong incentives in the influencer space that I disagree with. So that's 80% of success, because the title, right, is very important. And the title you only have up to 100 characters, so you have to really make full use of it. Recently I'm starting to be a bit more concise with my title. So maybe like I try to do like 50-60 characters instead of using the full 100. Because the back half of it gets chopped off. Yeah, so that's something to take note of. Mr. Beast used to say that in every video, right, you want to get 1% better. You want to get 1% better with every video, right? So my today's video should be 1% better than last week's. So you're compounding, right? Because every time you make an episode, you get better and better and better, and people will notice that quality. So I think you can set that kind of standard for yourself, you know, to always find something about your video to improve. Whether it's the thumbnail, it's the title, it's the, you know, the content strategy, like what topic you're talking about. Has everybody else done it already? What's so special about it? And all these things. Find different angles to always improve your videos by at least 1% each episode. And you gotta keep grinding. It's really important thing, you gotta keep grinding, because I'll tell you guys something. I started this channel only last year, right? And for the first couple of months, right, you know, I had to beg my wife and my friends to watch, because nobody wanted to watch my content. Yeah, so you know, when you first start, right, it's kind of like you are filming and into the void. Like you don't know, like there's no views one. When I first started, I only had like 1 or 2 views, or sometimes even 0 views, right? A lot of the views that you see in my first videos, right, like a couple of hundred, couple of thousand, right, they only came in after I started to gain traction. So I think my main point to you guys is don't be disheartened. If you want to be a content creator at the start, just keep going at it, and all you really need is one big hit. For me, is I had one video that was I hit like nearly 100,000 views, and then that's the one that made all the subscribers come in. So once you have the flywheel coming in, right, your subscriber base will move very fast, and then your viewership will go up. Yeah. And then another thing is you really got to listen to the feedback in your comments, right? I really try to read all the comments in the comments box, but obviously today it's reached a point where every video I post is really quite a lot of people. So you know, I can't reply everybody's comments, because if I do, then that will impact my next video, right? Because it eats into my next video production time. Yeah. Oh, look at polar bear there. Grizzly bear. Yeah. So yeah, you gotta listen to feedback, because I actually make a lot of micro adjustments in my content based on what people actually tell me, and then I make the adjustments and I keep trying to improve. So even though I don't reply to all your comments, I'm actually listening very carefully, and even the most critical ones are. You know, recently there was someone who commented that my channel is it becoming like just a reading of my investment blog at contractor.com, right? Because I write like all the investment stock articles, right? You know, from that feedback, I took it very seriously, right? So I started to refocus on my content, and sometimes I still want to talk about my investment strategies and stuff from my website, but I try to balance it with more overall content of everything here in Singapore. So, you know, feedback is really important. You want to have variety of content. I find that some YouTubers, they're just repeating the same content over and over again. I tell you guys what's the joke. You know that YouTube has demonetized my channel, you know. Apparently because, right, I am doing non-unique data, non-unique content, you know. YouTube says that I am doing repetitive content. I don't know whether it's because I use AI to do thumbnails and my introduction is the same every episode. So I'm going to change that up. But I find it quite ironic. I find that the topics I talk about, every video that I do, I really try to make it unique. So I don't know how I got flagged for that. So I got demonetized. But you know what? I'm just going to keep pushing content. It doesn't matter for me, you know, because I just want people to hear some of my views on YouTube. Yeah, and then I think the last point I want to share is when you're doing content creation, I think I realized, you know, don't be a politician. Just be a content creator. I realized you cannot please everybody. You see, like my recent video, right? I did a video on condo is a jail cell for Singaporeans, right? I wrote like that on purpose, right? Because I wanted to really capture people's attention with that. And I really mean what I say for the title, not just capturing for the sake of capturing. I really do mean what I say, that I really think that, you know, condos can really be a jail cell, especially for Singaporeans who can barely afford the mortgage, or just nice, you know, you just have enough household income to afford it. Because then you don't have any money left to do anything else. You cannot go holiday, you cannot eat good food after you pay your money mortgage, right? Especially in the current high interest environment. And with the Iran war that's going on, I don't see how the interest rates will fall any further. It might even hold steady for quite a while. So we're probably not going to go back to the ZERP days anymore. Yeah. So, you know, don't be a politician. You cannot please everybody, is my advice. Everyone's beliefs is different, and, you know, you just got to authentically show what your beliefs are without pandering to everybody. Yeah, so that's the next thing. Oh, look, it's what is this animal? That's a woolly mammoth there. Look at this. Look at this Bronchosaurus. It's moving. Look at that. What the hell? Right, the next question. Wow, this one, yeah, portfolio review and allocation. I haven't shown my full portfolio in a while, so today I'll make an exception. Yeah, but anyway, this is my portfolio. Well, I'm showing my portfolio. I'm showing you a turtle here in the turtle in the. Is this turtle or armadillo? What is this? What is this animal? What? It's a turtle, right? Yeah. So anyway, my portfolio, right? The cash is fully deployed, as you can see. I'm pretty much waiting on new RSUs to vest, and like my monthly salary moving forward. And so, to move the needle, right, from here on, right, because of the size of my portfolio now, right, I actually need to sell positions already, because there's no more spare cash. Or the spare cash that's coming in will be inconsequential compared to the size of the portfolio, right? Because the size of the portfolio is like more than $500,000 now, right? So if, you know, I can invest, let's say, a couple of $1,000s every month, right, or every 2 months, right? If you compare that to the size of the portfolio, that doesn't move the needle anymore, right? So if I have any new conviction and I feel very strongly about it, I will be forced to sell positions in order to fund that. Yeah, so that's the new dynamic I have now. Yeah, it's not like I'm waiting for some toto or something that I strike big money that, you know, $100,000, $200,000 that is significant compared to the size of the portfolio. That's no longer the case. As you can see, my biggest position is Meta. It is my highest conviction, right? And it's not just about valuation. I think I keep hearing people say in the markets now, like, oh, you know, Meta is the lowest valuation now, so let's buy into it, right? What else? Microsoft is the very low valuation now, right? After the whole thing crashed with GPT, you know, losing its polish against Anthropic, right? Let's buy into Microsoft. These are very valuation perspectives. I actually disagree with that. The reason why Meta is my highest conviction, right, it's been the case for the last 3-4 years. Not because of valuation, but because I know that the growth of Meta outpaces a lot of the other big tech. Meta grows at over 20% year-on-year revenue. I think the most recent one quarter was like 22%, if I'm not wrong. And you know, this year, right, Meta is actually on pace to eclipse Google as the biggest digital advertiser. So in the short term, yes, you know, a lot of these positions, they will close up because of valuation. But in the long run, right, if you're really invested for the long run, for like 5-10 years and beyond, right, the growth rates, right, how much revenue it makes, how much profits it makes, right, will eventually eclipse whatever short-term valuation closing up. It will. That is a fact, right? So that's why, right, you know, even after I made a lot of money from Meta in the first 1 to 2 years, right, back in 23, right, after the Fed crisis, right, I bought in after the crash, right, and I made a lot of money because I caught Meta's highest ever historic run in a single day. Well, how many percent was it? It was like 10 or 15%, or even more than that, right? I caught that run. But I didn't sell out a position, because for me, my thesis on Meta is long term, right? Number one, it is the highest revenue growing FANG company, big tech company on the Mac 7. Number two, I'm very, very confident about its network effects. Even TikTok has failed to make a dent in its network moat. And then number three, Zuckerberg has huge skin in the game. 90% of his net worth, more than 90% of his net worth, is in shares in Meta, right? So if Meta shares crash, his own net worth also crashes. So he's constantly, like, he cannot be complacent. So I like this kind of skin in the game where, the CEO or the chairman is on the same boat as shareholders. Yeah, and for me, apart from the moats, I like the optionality. I really think that the Meta Ray-Ban glasses is going to be a huge deal. I know there will be some people naysayers who will say like, Apple is coming up with glasses, Google has a better ecosystem. But I tell you guys something, I have inside information. I cannot say where I work, but I already knew that the Ray-Ban glasses was a crazy success since 3 years ago. I was actually involved in the project. That's all I can say. I cannot say too much. I was involved in something related to the project. Okay, and so I had some information that I saw some of the initial sales numbers, and that's when it struck me, right, that they are kind of keeping on the lowdown. That is actually a running success, and we can see now in the market, it's the most talked about. I think that Zuckerberg he does talk about it during the September Meta like stage showcases, but he's not super try hard about the marketing. Sometimes he does appear at the glasses, but he's not super try hard. I think the reason for that, right, is because he's trying to buy himself time. He knows that the other companies, right, will rush into the market once they realize how profitable and how successful this glasses is. It's very similar to AWS. When Amazon started Amazon Web Services like more than 10 years ago, right? Amazon refused to reveal the exact sales revenue numbers for AWS. They kept it hidden and buried until a certain point where AWS grew so big, right, that they had to declare because of compliance issues, because the SEC required them to reveal those numbers. And so I believe Meta is doing the same thing with glasses. They will not very granularly break out all the numbers. They will give you some hints. They will say like it grew how many percent here and there. I think like even the EssilorLuxottica, which is the glasses supplier of Ray-Bans and Oakleys for Meta. I think even they give some clues, like they say like the number of glasses has doubled or tripled. So if you guys have been catching this number, is huge, the growth. So anyway, this is my one of my biggest optionality plays for Meta. Is I really think the glasses will be a running success. And personally and anecdotally, right, as a father, right, I find that a lot of moments I want to take pictures or videos of my baby son, right, as he's growing up, right, like maybe he takes his first steps or something, it's out of the blue one. Then I need to scramble to go and find my phone. But if I'm wearing the glasses constantly, all I need to do is just activate it with Meta AI or just tap the side of the glasses, and then it will just start capturing it. So I think there's a huge use case for this kind of serendipitous moments of capture. That is why I'm so confident about the Meta glasses long term. But we shall see. That's my optionality play. So my second conviction you can see. So anyway, when I look at my conviction, right, how do you tell which is the stocks that I have the most conviction on, right? It's not the market value of the positions in terms of percent. It's the cost allocation, because that tells you how much money, right, I am putting in, right, from my own capital, rather than the market moving the stock position to where it is in the market value. So if you look at the cost allocation, right, you can see that Meta is my biggest conviction for all the reasons that I mentioned earlier on. Accnting is second. Accnting is an extremely volatile stock, and not financial advice. Actually, I'm very scared because I realized there are some friends who watch my video, right, and then they bought. I met some of them recently. They told me they bought. Then I don't think they got a good price. So as you can see, my cost price is very palatable. Right, I started accumulating this stock at 290. A lot of my positions were bought at 290. And then as it grew, it actually tripled all the way to 900 and then crashed all the way down to like 390, 400 or 400 plus these days. And now I've been averaging up and up and up as the price went up. So my cost is about 400 plus now. Accnting is my second highest conviction and my most speculative stock. So it's currently in the early growth phase. The cash flow margins are not optimized yet, right? So what do I mean by that? If you compare it to very mature cash flow companies, like let's say Mastercard or Visa, right? If you look at the free cash flow margins, right, it's very, very high, right? Because it's a very mature business, it's very stable, and people know what to expect every quarter, every year as it continues to get cash flow. So there is a double-sided consideration for this kind of thing. When you have stocks that are so free cash flow margin strong, there's usually less speculation. This is my thesis. So I believe that where a stock has more speculation, right, the alpha upside potential of the stock, right, in terms of the stock price, right, is usually higher. Because if you think about it logically, right, when there's still speculation, it means that people have a lot of unknown doubts about the stock and the company. So they don't know whether the company will survive or will succeed or continue to grow revenues at a high rate for the long term. And so this speculation and this unknown and this doubt, right, it prices itself in the stock price, in today's price, because people are uncertain, right? So, but uncertainty pays if you are right. So that's the catch. So the long story short is, if you find a stock where it is very, very stable, like Visa or Mastercard, right? Which, by the way, Mastercard is still growing pretty decently. It's growing like mid-teens, like 15+%. So it's not too shabby also. But like if you find a stock that is very, very stable, the next growth story is all pretty much all sorted out, right? The risks are much less compared to a company like Accnting, then your future upside usually will be much less. So that is a trade-off that you have to take. And I think that one consideration you can consider is how much time horizon you have. Right? If you're very young, again, this is not financial advice, but for me, I'm still young. I'm in my late 30s. Well, I'm turning 40 already. I have at least 10 years plus to go. I can afford to play speculating stocks, provided that I believe that they have a long-term moat of success. And so I think for me, for Accnting, it is still early days, and that's why I'm so invested in this as the second. The stock price obviously is not reflecting this yet because of the whole Claude Code SaaS apocalypse. But I think in time to come, when the market realizes, how much optionality this company has with the drones, with how widespread the body cam market is, it takes up over 90% of the body cam market in the US in law enforcement, as well as the electrical, non-lethal, less lethal alternative weapon for law enforcement market is like more than 90% electrical weapon. I think when the market starts to realize this, that this company is not going away in spite of AI, I think that's when we'll get a lot of alpha. But this is my thesis, not financial advice. I know that there are also SPC concerns. For me, there is no stock which is perfect. There's no stock. You want a stock that has no risks, then your upside is probably low. You want a stock that there's 100% perfect is impossible. So for Accnting, I think one of the biggest problem that a lot of investors have is the SPC. And for me, the reason why I'm still okay with this SPC is because, firstly, the SPC is performance-based. It's not time-vested. So I'm in tech myself, right? There are two different kinds of vesting. One is a lot of the executives, they get performance-based vesting, which means, right, they need to hit certain revenue targets, certain market cap, etc., before they get awarded like the RSUs, right, the stock options. That's performance-based, and that is a good way to get stock. Why? Because only contingent of you as an executive hitting the company targets, improving the intrinsic value of your company, then you get the stock. That makes sense. The other second one is time vested, which I'm on in my company, which means every quarter I am given X number of stocks, right? Whether I'm a shit worker, right, or whether I'm a good worker, right, it doesn't matter. I get this chunk of stocks every quarter, right? But if you do that for executives, right, that's bad, because it means that they can just coast around and not really contribute, and yet they still get stocks. So we don't want that, right? For Accnting, in terms of SPC, the SBCs for all these executives like Rick Smith, everyone, right? These are performance-based. So they do not come about from time, right? So that's number one, that's okay with that. Number two, if you think about it, right, if the SBC, right, is the main reason, right, why a stock cannot perform, right, over time, right, and it keeps crashing, right? Think about it, very logically, and then the executive himself, right, like Rick Smith, the CEO, right, he takes the majority, in fact, all of his compensation every year, right, a stock. If his stock doesn't go up, right, and the SBC that gives him his stock, right, is the main reason, right, for his net worth not going up, right, what do you think he's going to do? They're going to reduce the dilution. Because if SBC is the main cock blocker, right, that's blocking the stock from going up, right, then the executives that are making money from the SBC will obviously manage this problem. So this is an artificial problem that can be managed, right? It's not like organic problems where a company cannot grow its earnings because its products is not in demand. This is very, very different concern. The SBC, right, can actually overnight be changed in terms of policy, right, if the executives find that it is caught blocking their own net worth growth. Think about it. That's the second point. And the third point is the management realizes already that they need to manage dilution. So in the last quarterly earnings, right, the CFO already announced that the SBC dilution is going down from 3% stock issuance per year to 2.5%, right? So that's really actively being worked on. So these are the three reasons why, for me, SBC is really not a concern for Exxon. And also, if you look at a lot of companies in the early stage growth, right, like what Exxon is, right, like in the early days of I can't remember, was it Amazon or a few other big tech, right? Actually, it's the same thing one. The SBC, all very big one. End of the day, it's not the SBC that's the most important. It's whether or not the company, right, has a very strong moat and can continue to grow earnings and revenue at a very good rate. And for me, the Exxon, why am I so confident about this, right, is firstly, they have a very, very strong install base of the body cameras and the taser, right? And secondly, they have a path to profitability, right? What do I mean by that? If you look at their software gross profit contribution, right, it has already crossed the 50% mark a couple of years ago. And so as the company's revenues continue to grow, right, in evidence.com, right, this part of the software gross profit contribution, right, will continue to increase in terms of percentage. And I know there's a concern where people say, oh, you know, AI is going to depress the margin profile, because if Exxon wants to include Claude or GPT in its AI era software, they need to factor in the cost of goods from all this AI that is needed to empower their AI era software, right? That is true, but I think that the bigger picture is being missed here. What is being missed here is that people are focusing too much on gross margins and forgetting about the overall gross profit. So what I mean by that is that yes, with AI you have lower margins, but with AI you have even more revenue because it introduces even more software products. So for example, for Exxon, they have a body camera translation where the police officers can just tap the camera and it translates whatever the victims or the criminals that they are interviewing on the spot, and that uses AI at the back, right? And over time, this cost basis for AI will actually go down over time, because a lot of the open source models that come on the market, like OpenAI, open source, etc., or even Meta, right? They will result in a lower and lower cost basis, because these are much, much cheaper than the frontier AI lab models, like the latest Anthropic 4.7 or the GPT 5.5 that just came out, right? You don't need that to do translation, right? So a lot of the police field work is very, very basic. You don't need the most frontier models to make it happen, right? So I think that's another consideration. It's not a big deal in terms of the AI margin issue. So that's why the whole SaaS apocalypse thing, I think it's just overblown now. Yeah. And again, I want to stress, not financial advice. I think it's just a matter of time horizon for Exxon. If I'm investing in it not for a quick 1 to 2 years gain. That's why even when it went up to $900, like what last year, right, I didn't sell. Right, it crashed down to $300 plus $400, right? I'm okay with it. I didn't sell also. I don't panic, right? Because I think that over 5 to 10 years, this company will succeed, right? In terms of third in my conviction of my portfolio, Mercado Libre and Netflix are tied. Recently, I actually like Netflix's forward prospects a bit more. The advertising in the latest quarter is now only 6.5% of last 12 months revenue, and it doubled from last year, right? It's only 6.5%. That means, right, that there's a huge runway, right, for Netflix to monetize its audience base and then squeeze out advertising out of all this audience base. It's a huge runway because it's only 6.5% of total last 12 months revenue. And they are starting to pull on a lot of levers, right? Recently they have success in the what do you call that? Live shows like the Taiwan Taipei 101, where Alex Honnold was climbing the Taipei 101, Japan baseball, the WWE, etc. And then also recently in the quarter, analysts are starting to notice that they are going into mobile gaming also. So this could potentially become, Netflix could potentially become an all entertainment subscription, and that will justify continued price raises. For Mercado Libre, for me, the thesis is very simple. It's just early days Amazon, right, with a lot more focus. What do I mean by that? So you look at the competitors like Shopee or Amazon, right? They all have their home markets to contend with, right? So like Shopee needs to contend with the Southeast Asia market, which we all know. In Singapore, we all use Shopee, right? Which is why in 2022, when the Fed crisis, macroeconomic crisis hit, Shopee C Limited had to close down a lot of their South American markets, leaving only Brazil, right? But Mercado Libre has never left the Latin American market. They've only been focused on Latin America, right? So there's a lot of focus there. And for Amazon, I know people are very worried. Amazon's coming to Brazil and Mexico and this and all that. But from a huge capital allocation point of view, right, that's not a concern, because as an Amazon shareholder myself, right, I know that Amazon's number one focus today in terms of capital allocation, right, is AWS. It's not Latin America, right? So if Mercado Libre wants to play this race of, really building out even more of the fulfillment centers and network, right, in Latin America, right, Amazon will not be able to compete to the same extent, because Melly is 100% focused on Latin America e-commerce, whereas Amazon needs to split its capital allocation focus between e-commerce in Latin America and different parts of the world, and AWS, which is his main priority. And you know something amazing? I'll tell you guys something. I think Mercado Libre holds the record, right, for look at the fish tank. For the most number of consecutive quarters above 30% year-on-year revenue growth. It's insane. They've done I think it was 28 straight quarters of growth. Yeah, 28. And so nobody beats Mercado Libre in terms of infrastructure in Latin America. And one other thing is, I think I mentioned in the last video why I think Mercado Libre is, for me, it's a better investment than C Limited. It's because all the pieces of its business is symbiotic, right? The Mercado Pago is like its PayPal. It feeds into the e-commerce, right? You know how it works, right? Basically, they have this system is really cool. If you are someone who doesn't own the Mercado Pago credit card, right? You can apply for it when you first buy something on the e-commerce platform. So when you make an order on the site, right, like how we do in Shopee, right, but they have the same thing, right, they will ask you if you want the credit card, and then you can just apply for it while you're making the purchase. So they bundle everything together, and then they also have data to see if you are a good customer for their Mercado Pago payment system, whether you will default on your loans, on your credit card bills, right, on your card loans, right, because they can see from the way that you spend from the e-commerce whether or not you are a reliable customer. So all the parts of his business, right, is symbiotic one, right? Whereas for C Limited, it's a bit more spread out. The gaming section for Garena is just giving cash flow to the rest of the business. That's it. It doesn't help the rest of the business. Yeah, so that's the reason why I invested in Melly over C Limited. And then my next down the conviction list is Amazon. I think for them, they have a huge revenue base, which can be refined further in terms of the margin profile with robotics. Right, they are doing a lot of developments in robotics now. So when you have such a huge revenue base and the profit margin is still not clean, if that's the right word that I use it, there's a lot of leeway to improve the margins by replacing the human labor with robots. Then that means that the runway for increased profitability is very long, right? So you can get to ride that runway, right? So I actually reallocated a huge chunk of my Amazon to Meta, which both stocks have gone up a lot already, so I'm happy with both. But I actually reallocated because I believe that first-party AI companies benefit more, which is Meta in this case, because there's more visibility of ROI. Right? What do I mean by first-party and third-party? It's kind of like for Meta, if you buy GPU compute, right, to train your AI models and then to serve your inference and to serve your advertising network, right, it's for yourself, nobody else, right? But for Amazon, for AWS, what you're doing here is, oh wow, check out the Stego. This is Stegosaurus, right? Look at the Stegosaurus. For AWS, right, Amazon, right, the capital they invest to build out all these data centers, right, is to supply compute to third parties, like all the startups or all the companies to in turn use AWS to function, right? Like how AWS provides compute to Anthropic Lab to train the AI cloud models, right? Or AWS provides compute to Netflix or different companies around the world, right? So these are third-party use cases. So the ROI is not so direct like Meta, right? Because AWS depends on the consumption of third parties to get an ROI. So the visibility is not a straight line. But for Meta, whatever compute that Mark Zuckerberg invests in, right, GPUs and all these data centers, right, is for itself. So it has a very clear sight of visibility into ROI, right? If I invest in X amount of GPU compute today, right, it jolly well add to my bottom line, right? And I know it will, then I invest. But for AWS, right, you are kind of leaving the fate of whether or not the compute capacity you build on AWS, right, will really have continued consumption from third parties, right? Because you're not consuming as much as yourself. The reason why I made the reallocation is because in the last quarter, Amazon made an alarming declaration, which me and my friend Sergeant caught, which is that Andy Jassy said that the majority of AWS compute consumption is not internal. So I was completely taken by surprise there because I thought that it would be internal, right? Whereas for Google, it's 50%. So Google is 50% of Google's GPU or all this data center compute, right, is used for itself, for Google search, for Gemini, all this stuff, internal consumption, right? And then the other 50% is for Google Cloud Platform, which is for third-party consumption, right? So there's a bit of risk mitigation there. The best, in my opinion, is still first-party. Why? Because you get to know whether or not whatever compute you invest in truly benefits your company. Whereas third-party, you kind of need to wait, and then you need to predict, will people buy the compute I'm supplying now? So you guys understand, you are dependent on the fate of others. But for Meta, they are depending on the fate of themselves. They control their own destiny, what they want the compute to do and to shape out, and will it really help them? If it doesn't help them, then what will they do? They will just scale it down because they immediately know, oh fuck, I over-invested in compute and it doesn't really help me, right? For AWS, they do not have the same amount of visibility. For GCP, Google, they are 50-50. So the risk is mitigated, right? So this is one of the main reasons why I did some reallocation from Amazon to Meta. In the short term, maybe Amazon will go up a lot. It doesn't matter. I know some people will say, wow, you lose out, you're so stupid. Amazon price goes up. But if you're invested for this for the long term, eventually, right, these things will catch up. So it takes quite a lot of, I would say, courage to dissociate the underlying business and the stock price. Because I believe that eventually, over the long term of 5 to 10 years, right, the business will eventually close the gap. The stock price will eventually close the gap of whatever the business situation is in the future. Yeah, so I think this is one of the hardest part of investing. Now the last allocation I have is Mastercard. It's very small, it's like 2% or less. So I actually wrote an article on contraturtle.com. You guys are interested, you can check it out, comparing Mastercard and Visa. And I stated my reasons why I prefer Mastercard, because I find the value-added service, the VAS portion, going a lot faster. And the reason why I got a chance to accumulate Mastercard is because a couple of months ago, if you guys remember, the Citrini research report, which is very stupid, came out. And then it gave me a good opportunity to accumulate, because in the report it says that agents will take over the whole payment ecosystem, and agents, they don't need to use credit card, they prefer to use stable coin, or they prefer to use some other agentic means of payment that is not Visa and Mastercard, and it will skirt around all these payment network platforms, and then Mastercard just fell. It is written somewhere inside the report, and I find it super dumb. It's very stupid. I mean, I'm sorry, but crypto came out so long already, right? And then a lot of shit coins also came out, right? I ask you until today, right, have any of the protocols taken flight and overtaken Visa and Mastercard's market share? None of them have. Even after so many years, none of them. Okay, because Visa and Mastercard, the network is so mature and so good. They have security, cryptographic and enforcement, anti-hacking stuff that's built in. That's so good, right? Whenever your credit card there's fraud or something like that, you get notified straight away, right? So I think a lot of things are just so hard to be replaced, and I think Mastercard is very, very strong. But that being said, right? I view this Mastercard position as like a cash position. I know that's kind of funny, right? Because I find that Mastercard is just so stable that there is no way that it will die tomorrow or the next 5 to 10 years. And because it's so stable, it is less speculative, and similar to what I explained earlier on, if it's less speculative, it means the upside will be less, because there's no gap between the market's understanding today versus the future. So, in other words, the price is already priced in today, right? A lot of this stuff. So Mastercard, I'm just really riding on the roughly 15%, if I'm not wrong, year-on-year growth, which is very, very strong. And the fact that Mastercard is growing a bit faster than Visa, because a lot of focus on international markets. I know that there's a concern about a lot of local countries doing their local payment methods, like UPI in India or PayNow in Singapore, or is it PIX in Mexico, and in Europe they have the inter-European bank thing that's going on. But actually that's not a concern for Mastercard, because Mastercard's a lot of the profits in terms of network is coming from cross-border trade, right? So for example, if you're European and you want to purchase maybe Netflix or some American software or some American product overseas online, right? You would this is a cross-border transaction. You're buying an American good as a European. Or if you're American and you are going to the European countries to travel, you bring your Visa, Mastercard to buy stuff in Europe, right? This is cross-border, right? And in fact, the European-American holiday corridor, right, is, if I'm not wrong, the most popular travel corridor. So this cross-border trade is huge. So this is actually a lot of the how Mastercard makes money. Not just the domestic stuff that is being threatened by all this UPI and PayNow and all this stuff, right? But yeah, anyway, Mastercard is a cash position for me, right? I treat it like cash, which means that if I find that there's a better opportunity in Exxon, in Meta, or in another stock which is more speculative, but I believe in long term, there's a strong moat, even though it's speculative, then I may even reallocate Mastercard, because as you can see, I have 0% cash already. So if I want to raise cash, it has to be from a sale of Mastercard and all this. Which brings me to the point that there's this whole concept of opportunity cost, right? If Mastercard is 2% of my portfolio, right, there's an opportunity cost, because I could ask myself, why didn't I deploy this 2% Mastercard into a better position, even though it is more volatile, right? So these are some considerations I need to make. Yeah. Wow. What the fuck? Okay, the next question. While I'm looking at this Oviraptor, I tried taking on a margin loan of around 6 months of my take-home to accelerate accumulation of a decade-long holding. After about 40 trading days, I closed the margin position win. Claude suggests to reflect on symmetric outcomes, sell equivalent shares to realize margin losses. Any thoughts? Okay, firstly, congrats on your win. I have to say though, I am a bit worried, because I am worried that your win may set a bit of a greedy precedent for yourself. Because now that you succeeded, you'll be tempted to do it again. I'm pretty sure, right? But again, what I say here is not financial advice. Oh, I better move away. The raptor is very noisy. Uh, I have two rules when I'm investing in stocks. Okay, again, it's not financial advice. I don't want to get into trouble. People report me. I'm just saying that if it's me, there are two rules that I do not, I follow that I do not do. Okay, the first one is I do not buy on margin. And the reason for that is because I know it's tempting to want to accumulate and so-called accelerate the process of, like you said, a decade-long holding. But you think about it, if your time horizon is truly long-term, right, you don't have to rush now. You can take your time as your monthly salary comes in, as you earn your bonus or some other ways of increasing your income to slowly average into positions. No need to rush now. And also, the market will always give you a crisis. Last year it was Liberation Day. This year it was Iran war. 3 years ago it was the 2022 Fed crisis. Before that it was the pandemic another 2 years ago. Every few years the market will give you a crisis one. So you don't need to rush to go in, right? And the reason why I say that margin loan creates this sense of greed is because after you succeed the first time, then you think that subsequent times, whenever the market crashes, I just go and borrow money. Right, I always have access to funds. But what you don't realize is that with margin loans, right, I don't touch it is because sometimes low can go lower. Right? If 2008 hits again, which it might, if the AI bubble bursts in the future, nobody knows, okay? I'm just saying, if some shit happens, okay, the AI, maybe the Iran war becomes even worse, or the AI bubble bursts, or whatever it is, sometime in the future, and then you take a margin loan again, right? You take it after the stock crashes, maybe like 30% or 40%, right? 50%, whatever it is, right? And you think, this is it. I buy a margin and the stock has already gone all it needs to do already, right? And then, lo and behold, the market continue crashes even more. Another 10%, another 20%. You know what's going to happen to you when you take a margin loan to buy stocks, thinking that's the bottom? You get margin called, right? So what that means is that the broker, in order to protect themselves and as a form of insurance, because they are not sure whether you are able to pay the debt that you are borrowing from them, the margin loan, in order to purchase shares, they will demand that you deposit even more money to support your margin loan. Even though you don't take up more loans, okay, whatever loans you take out at this point, they will do a margin call on you. That's the first thing. And at that point, right, if you have no money, right, you're screwed. Why? Because you will be forced to do forced selling. They will force you to sell your existing positions from the broker, right? Can you imagine if I take a margin loan, right, and I need to liquidate Meta shares that I believe can continue to be even more profitable in 5 to 10 years, but they make me liquidate it at the bottom of the current market crisis. That's the worst possible scenario. You don't want that to happen, right? So here's my take. I know it's very, very tempting to get margin loans so that you can really sort of accelerate, getting even more holdings at a lower price, right? But if you are truly long-term, there's really no need to rush because there will always be an opportunity. You just got to be patient, right? So I think that the risk of ruin, right, from a margin call, right, is far greater, right, and is worse, right, than the upside of the margin loan that you are getting. In the grand scheme of things, that's my take, right? That's rule number one. I never buy on margin. Okay. The second rule is, just to share also, is I never short sell. Right? I will never short sell because this one is very, very simple. Short selling, your upside is limited, right? Because short selling, you make money when the stock goes down, right? But it's limited. Why? Because a stock can only go down to as low as $0. A stock price cannot go down to minus $1, minus $2, minus $100. There's no negative in stock price, right? So your upside is limited when you're short selling. But your downside when you're short selling is unlimited, because when you are shorting a stock, if the stock goes up, like what happened with GameStop, right? You guys know the kitty guy, right? A couple of hedge funds, they couldn't support their short position because the stock theoretically can go up forever. There's no ceiling to what is the stock price that can go up. It can go up to $100, it can go up to $1,000, it can even go up to $500,000 like Berkshire Hathaway's. stock, right? A couple of $100,000, right? So these are two rules that I keep very closely to myself. I never buy on margin, and I never short sell. So I really hope you can, sort of consider this. I cannot give you direct advice, but I hope you can think about what I just said. And instead, just try to figure out how to make extra money instead of borrowing money on margin. So things could be like, you could figure out like how to do a side business or side hustle. You could teach tuition, or you can raise your income through your career by getting a promotion, or job hopping, whatever it is. So you get actual real cash that you can then deploy. I think that's the more sustainable way to look at this. Yeah. And then you also asked about, you said that you use Claude, right, to do some trades and like some asymmetric outcome, all this stuff, right? Okay, here's my take. My suggestion, right, to most people, right, is never, right, ever use AI to trade stocks. Okay, if you actually understand how today's AI models like Claude or GPT works, right, you will know that you shouldn't use AI to trade stocks, because the AI, firstly, is not sentient. It is, I wouldn't even call it actually logical. The transformer model, right, which is the architecture which is built on, right, a lot of it is about pattern recognition and token prediction. It looks like it's logical, but it's actually more about trained data and pattern matching, right? There was this whole concept about the forward pass and back pass and all that stuff. But I wouldn't use, in a nutshell, I wouldn't use AI to trade stocks. Because at the end of the day, right, because it is trained on past human knowledge, right, essentially it represents an average human capability, the mean, right? So when you're using AI to do all this trade, right, what you're really doing is you are adhering to the mean, the average human, in terms of your decision to trade a certain stock in a certain position. So if that's the human mean, you think about it logically, right, then what's your alpha, what's your edge against the human mean, right? I think Claude is good if you want to do stock investment research, right? Using AI, because you can research about the pros and cons of a company, what are the theses of the company, and then you make a decision for yourself whether to play long term. But if you're doing it for trading, I really don't think that AI is appropriate at all. Let's have a change of scenery. I'm actually at the Suzhou Creek or Suzhou He. So what we're going to do now is I'm going to walk to this nearby place called the Sichang something, forgot what's the full name already. I'll probably show it on the video later on, but we're going to walk along this Suzhou River, and along the way hopefully we see some flowers, because it's actually the Shanghai Jie, which is like a flower festival. The weather is absolutely perfect. So we're going to walk along the Suzhou River all the way to the Waitan, which is the Bund, and then you'll see all the very famous Shanghai landmarks like the Dongfang Mingzhu Ta and all this stuff across the Bund, which is quintessential Shanghai lah. But I thought it was a bit funny, because if I start at the prehistoric dinosaur museum, it's a bit weird, right? So maybe it's a bit wacky. So that I decided to start from there. Anyway, I want to move on to the next question. You're less than 1 year of experience here. What's my thoughts on management associate programs? Also in the accounting and finance industry, what could juniors value add given AI advancement? Is professional certification even worth it now? I realize I'm getting a lot of these questions from new grads. I think you guys are very worried about your career prospects. But maybe let me just try to answer your question in parts. Oh, what is this? A photograph museum. Photographiska. Look at that. Pretty cool place. So, management associate program. I think the idea is that in this program you are rotating across different departments, right? For like short stints and then meeting different people, right? I think in the grand scheme of things it's good, because as you are going through all the different departments, you on one hand can get to figure out what your true passions are, because you may stumble upon a department where you really like the work that you're doing there, and then you also can see departments that you don't like to work there. So I think that gives you a very good overview. That's one thing. The second thing, which I think is the most underrated part, is you are actually building relationships across different departments. So no matter how shitty the departments are, right, if you go through this program, right, I just want to remember that whatever work you're given, whatever responsibility you're given, whatever people you meet, right, you have to really make sure that you cement your reputation as, you know, a really reliable person that is a go-getter, self-starter, and who is proactive and takes initiative. All right, so I think the relationship building is key as you go across the departments, because later on, if you do well and then you go up the ranks, you know, you'll find that it's a lot easier to do work because you have so many connections everywhere. All right, and then like my ex-boss, he used to tell me that T-shaped individuals are really important now. When he told me that, at first I thought it was bullshit, but actually I've come to realize over time that he's right. Right. So what I mean by T-shaped individuals is you want to have a very broad understanding of across your company and industry what's going on, and then you want to, like the letter T, right, you want to really drill down to be really good at a certain forte or a niche. So I think this management association program, the rotation, can give you that broad-based horizontal part of the letter T. So I think it's a good start, because honestly you're less than 1 year experience, right? You do anything, it really doesn't matter, just do your very best and build connections and then build out your reputation. So I know I don't have very conclusive yes or no whether you should do management association. I just think I just think in general it's not too bad. The second part of the question you asked is you know, what could juniors value add given AI advancement? Okay, I think I mentioned this in the last episode. By the way, I think this is the number 4 warehouse thing that I am supposed to show you guys. It's like some huge abandoned warehouse that they refurbish into some artsy place. But anyway, in the last video, right, my last AME, right, if you watch it, right, I mentioned about you have to ensure that even if you go into all this accounting and finance, right, you have to make sure that your AI use, right, is reflexive. Meaning you have to use AI like it's second nature to you, right? And I think if you're so young, right, you're a new graduate, I think it's not a problem. So really start getting used to Claude, Anthropic, GPT, Gemini, understand the nuances between each one. You know, even better if you can learn a bit of coding, so you actually understand how Claude Code works and some of the capabilities is capable of delivering, whether it's in accounting or data analysis, and then marry that with your domain niche, which is what you're studying, accounting and finance. If you can do that right, and always have a finger on the AI button, right, I think you will survive very well. Yeah. I think one thing about being junior is that a lot of AI advancements are coming. So a lot of the older folks, right, I realize, right, they are very bogged down by dogma. They refuse to change. Right. So I'm getting feedback. Like, for example, I talk to my wife sometimes. She works in the finance industry, and she tells me like all the old dinosaurs, they are very, very slow to embrace AI and a lot of skepticism. But it's like young people like you, right, and maybe me, I'm not so young, but you know, I consider myself to be very open to new ideas and to try new stuff. Oh, there's a lot of incoming traffic. All this wearing the scooters. This is the number 4. Oh, it's called the Joint Trust Warehouse. Interesting. I don't know what is this thing for. Oh, it's a cultural site. 四行仓库抗战旧址, the former site of the Sihang warehouse battle during the War of Resistance against Japanese aggression. I didn't know that. Okay, so this place actually has historical importance. No, I'm not going to go in now. I'm just going to go along to the Bund, which I think is more scenic, and as I talk to you guys. Anyway, yeah, the older folks, right, they have a lot of reservation. So, you know, as a young person, right, I think you're very nimble and open to new ideas. Hopefully, to try all this AI stuff. But the idea, right, I tell you now, the expectation in the market now, right, is one person, right, must be able to do 3 to 5% job, or maybe even 10% job with AI. Yeah, it's damn lame, even in tech industry especially. That's why all these companies are getting crushed. Like Meta, all this, they just announced 10% layoff. Amazon announced layoff. Microsoft is announcing a voluntary layoff in its 51-year history. It's not done in the last 51 years where they ask people to, they ask their employees to voluntarily take out a package to quit their job, right? So their margins go up and their OPEX goes down. All that in exchange for channeling capital from OPEX into CAPEX. Actually, I really predicted this already. Don't you guys follow me? You know that I mentioned this before. In technology, we are now having a trend where capital, right, is being reallocated, right, from OPEX to CAPEX. Basically from humans to machines. Yeah, and I think it makes more sense because humans ask for increased salary every year and machines only go down in cost basis every year. Assuming ceteris paribus, the technology of the machine is the same, then the cost of paying for it goes down every year because of commoditization pressures, right? Okay, am I going in the right direction? Let me see. Yeah, this is correct. So that we are walking slowly towards the Bund now. So anyway, back to your question. So that's the first thing. How do you add value, right? Is you have to use AI reflexively. I can't speak for professional certification, but all I can say is that domain knowledge, right, is very important to verify AI outputs today. Because I think this problem with, oh my god, hold on. Ooh, it's insane traffic. I think this problem with, oh, look at this muscular guy. Look guys. Look at his 8-pack. Look at his 8-pack. Look at that. What the fuck? The problem with AI hallucination cannot be resolved. So right, companies will always need domain niche experts to verify whether the output of AI is correct. So if you are in accounting profession, you get your professional certification, it proves that you are a domain expert after X number of years, right? So in a certain sense, the paper is also important. It certifies you as a chartered accountant or whatever it is, right? So that you can, in the future, verify the outputs of AI. That's a really crucial point. You're no longer creating the output. So for example, I'll give you a tangible example. If let's say you are, the old world is, you need to manually type into Excel all the accounting spreadsheets, right? The balance sheets, check the cash flows, and then check the income statement, right? Which is what we do in investing also, actually the same, right? In the new paradigm, which is already happening, right? You can use Claude or some AI to auto-generate your accounting statements and then to summarize what are the, red flags or yellow flags in the statements, right? And then you as the accounting certified expert, right? You would actually serve as a verifying expert to see if these outputs on AI make sense. I think that's the future. You can mark my words, we see in 5 to 10 years whether I'm correct or not. I think this verification part, right, will sweep through the entire world, all professions, from accounting to finance. You are investment analysts, credit analysts, loan analysts, anything that requires verification of outputs, right? For engineering also it's the same thing. It's happening now already. So now it's about engineering managers, right? They look at the AI outputs of code that junior engineers write together with AI. Some of them don't even have junior engineers. They just use AI outright. Yeah, so the whole thing is getting shifted. So you really want the credentials to prove that you are capable of verifying outputs. So I think there's a case to say that your professional cert, right, I think it's still justified. Okay, the next question. Thoughts on topping up CPF, like how Mr. Loo advocates 1M65. Wow, the weather is looking beautiful, man. Look at this. Holy shit. I think that for 95% of people, what Mr. Loo says is correct. But full disclosure, I don't do this. I'm not saying that I'm special or what. I'm not saying, wow, I'm elite 5%. That's not my point. It's just not financial advice, but just personally for myself, I think, based on at least my last 5-6 years of track record, I think I can allocate cash better in my own stock investments, better than whatever CPF gives me, right? Because CPF gives 2.5% OA and 4% on SA, etc., right? For me, in the last 5 to 6 years, I've done 15% on average long term. At a certain point in the first few years, I did 24%, which I knew was not sustainable. I knew it was going to go down. So now I've landed on an average of 15, 16%, in spite of Exxon, Meta, all these stocks, doing not the best in the last 1 year, right? I'm still doing 15, 16%. So that clearly still beats the market. And that's on a TWR time-weighted basis. So time to time I do update my portfolio on my website, so you can go and look. But I don't look at it every day lah, because remember, like I said just now, I don't try to obsess over the short-term performance, because honestly all these are just short-term aesthetics and optics. They don't really matter. What really matters is every maybe 1 year, 2 years, 5 years, 10 years, I check into the portfolio and I see how it's doing. I think that's more important. Anyway, coming back to your point about topping out CPF, right? I think what I do is really not for everyone. What I do really requires tremendous conviction and stomach for volatility, and I really focus on my circle of competence. So I only own like 6 stocks, and on my watch list, if I add up everything, there's like less than 15 stocks all in. All right, so very likely in my investing lifetime, I will only own like less than 10 stocks. I think very likely over the next 5 to 10 years. Because there is this whole concept of opportunity cost. I think there's a question later on I will cover on that. Somebody brought it up, so I'll talk about that. I think age is a really important factor as to whether Mr. Loo's question applies to most people. The older you are, the more stable returns you want to seek, right? Because as you're nearing retirement, your ability to, can you guys see there's the Dongfa Minzu Ta over there in the horizon? The ball, the one with the 2 balls, Gintama thing in red thingy over there. Right over there. Yeah. So I think age is really important, because the older you are, the higher the risk that you cannot earn income through jobs, right? Because I think the whole stereotype is true. The older you are, the higher the probability that you cannot get an equally higher paying job, right? Unless you have a niche that's really amazing and continues to pay you well, which is possible, or you are in a management position and you're doing very well as an executive, right? So the older you are, the more stable the returns you want, and I think there's a higher stronger case of you needing to top up the CPF and play the CPF game, right? Which I think is a lot of Mr. Loo's audience, which is absolutely correct. So I think it really depends on age. It also depends on risk tolerance, what I just said, right? Some people, you could be young. You could be like me in your 30s or 20s, younger, right? You have a huge, long time horizon, and you probably can earn good money. You have a long runway for your career. But the problem is, you cannot sleep well at night, right? You cannot sleep well at night because if you invest in growth stocks or some other things apart from CPF, right, more speculative instruments, number one is you cannot handle the volatility, so you don't sleep well, and that affects your day-to-day. You shouldn't do that. Number two is, maybe stocks is just not your cup of tea, just not your passion, or just not your circle of competence, right? So you shouldn't. You shouldn't force the issue. Right? So I think it's a combination of risk tolerance and age. But I would say that 95% of people should do what Mr. Loo is advocating for, which is to top up your CPF. You can gain some tax advantages, right? Some people, they top up their SRS and all this stuff. I think these are very suitable for 95% of people. But full disclosure for myself, I don't do any of this because I think there's an opportunity cost of allocation based on my track record. Yeah, but this could change in the future, but we'll see. As I go closer to 50, 55, I will make adjustments. I will shift it to a bit more stable instruments, more CPF and more fixed income or more dividend stocks. Yeah, but I think this kind of thing is, see as I go lah. Okay, the next question. Do you use any AI in your investment? What do you use it for? Any prompts that is useful for investment? I use AI like literally all the time for research, right? For everything lah, fact finding, quickly summarizing articles. So nowadays, right, I realize that we live in a world, right, where your email inbox, right, and the things that is being flooded at you, right, inundated in your feeds, right, your Twitter feed, your Instagram feed, your all your subscriptions to learn stuff, right, is too much already, right? So I developed this system where I actually, what I do is I actually have Claude summarize every investment article that I shortlisted to read and give me a quick summary. And only those that I'm really very interested in, right, I want to deep dive into, right, then I read manually. That's a bit of system I do now. So for casual browsing, I use AI now to summarize the investment article to get a very quick takeaway. But for things that I'm very interested in, I do manual reading. Just to share about that. Okay, how do I go over to the other side? I need to. Okay, I'll go back here. Now, there's some important techniques I want to teach you guys when you use, when you prompt AI, when you're doing research for investments. The first thing is you must understand this trait about how AI models are sycophantic, right? There's this concept of sycophancy. It sounds like a very fancy chim word, but to simplify, right, sycophancy just means, right, a bit like agreeing with everything you say, right? So for example, let's say you ask the AI, right, why is Exxon a good stock? The AI, right, will likely find all the reasons why it's a good stock because of the way you ask the question. On the flip side, right, if you open another AI session with Claude, right, or GPT or whatever AI you want to use, right, Gemini, right, and you ask the opposite question, right, why is Exxon a bad stock? It will probably find you all the reasons it's a bad stock and conclude it's a bad stock. So it's like, then you're wondering, then what's the AI stance? How come you can give two versions, right? That's the meaning of sycophancy. Right, the AI just agrees with you as and when. So it's like patronizing you, right? So it's important when you're using AI, right, you need to combat sycophancy. And the way to do that, right, is you need to ask the AI to argue both sides. So exactly what I just said just now, right? You need to ask the AI the good question. Why is this thing good? And why is this company bad? And you yourself, right, need to make a decision based on both sides of the argument. What's the outcome? You cannot rely on AI to make the judgment for you. You have to remember that, right? Because the AI, right, a lot of the architecture is based on next token prediction. So, if you started your sentence with why is it good, right, it will find articles or past training, right, to verify why it is good, just from pattern recognition. Yeah, and vice versa for bad. Okay. Andre Caprotti, who is the ex AI lead of Tesla, he's done a lot of amazing work in this aspect. Really good. One of the things he's done, which I'm going to be looking into it soon, I think solves this problem of sycophancy. Well, not solves it, but reduces it. Is he created this thing called the AI LLM Council. So if you guys are interested, I think you should go read it up. But the idea is he is trying to reduce the amount of sycophancy and bias in the outputs of AI whenever he asks them questions. So for example, if you want to ask about whether Exxon is, what kind of company it is as an investment, the AI should, through this LLM council that he sets up, give a more neutral answer, which is exactly what you want as an investor. You want an objective answer to your investment question, correct? Yeah, so that's the one thing that I want you to take note of when you are asking AI. Your prompt, you have to firstly be aware that there's sycophancy. Secondly, another way you can reduce sycophancy is the way you ask, right? Don't put positive or negative words that will bias the answer. So for example, instead of asking why is Exxon a good stock or a bad stock, right, you should be asking something like, tell me the pros and cons of Exxon as a company, like that. So you put it both in the sentence. So in a way, you are not biasing. If you compare this question I just said, pros and cons of Exxon versus why is Exxon a good company, right, you can tell that this why is Exxon a good company is more biased, right? So remember, with the way you ask, right, you have to ask in an objective and neutral manner. So this is the flower festival. Wow, very nice, MXC 万象天地. Look at that. Look at all the flowers. Yeah, take a picture for Instagram. Nice. Take one more picture here. Let's go through this alleyway. What's going on here? 情绪收据 emotional receipt. What the fuck does that mean? The fuck? You get a receipt for something. I got no time to queue. Oh, yeah, so I want to teach you guys another prompt that is really useful for investing or just life in general. Wow, look at all these flowers. It's called the 95% prompt. I learned this recently and it's changed the way that I work. Let me just take a picture here. Wow, look at that. It's a carnival. So the 95% prompt is this. Sometimes, right, when you are investigating a company, right, you are researching maybe a new company like, I don't know, Meta or Booking.com or whatever it is, right? Sometimes you don't even know what are the right questions to ask the AI to begin in the first place, right? So like, there are two types of questions, right? The one type of question is, you know what you don't know. Because you know what you don't know, you know what to ask the AI, right? The second type of question is, you don't know what you don't know. So you don't even know where to start. What do I even ask the AI about this Booking.com or Exxon or whatever company I'm interested in, right? So right, the idea is that you should ask the AI, right, whenever you are stuck and don't know what you don't know, right? Ask Claude, can you interview me such that you're able to understand what it is I'm looking for in a company, such that you are 95% confident that it is what I want, something like that. Yeah, so I call this the 95% confidence prompt. You put the responsibility of coming up with the questions, right, to Claude. Wow, it's very noisy. Hold on. Yeah, so you put the onus on Claude to figure out the right questions to ask. So there are many ways to use this. One way to use this is in investing, in research. Another way is if you are building stuff or you're creating a business, you can also use this hack. So for example, I'm actually building an app. I'll let you guys know what it is I'm building. Quite interesting stuff I'm trying to solve. But along the way, whenever I'm stuck with building the app, right, I ask Claude to interview me and ask Claude to interview me and ask me the questions until Claude is 95% certain that is the vision that I want in the mobile app that I'm creating. Because sometimes I don't know what I don't know also, because I'm not skilled in app development. So I asked Claude to interview me. So you can apply this 95% confidence prompt technique to anything other than investing. Wow, this festival is very, very crowded, man. I'm gonna walk through here and talk about the next question soon. Let me just clear away from the crowd. Wow. Oh, there's a giant dog there. Can you guys see? It's a giant dog. Look at that. Look at this giant dog. The giant dog is made of leaves. Take a picture. Look at the giant dog. The hell? Okay, let's get out of this place. Okay, the next question. Managed to get out of the crowd. Still a lot of people here, so hopefully you guys can hear me. The next question is post-sales tech implementation in SaaS. Worried it limits future pivots as tech stack may not be relevant. As a SE, what's your view on mid-term prospects? Okay, so I used to be post-sales tech before, actually, before I shift to pre-sales. And then now actually I do both because I'm in partnerships. So I do both pre and post-sales, but the emphasis will always be on pre-sales because whoever brings in the revenue will always have more say in the company. So like I'm always biased towards pre-sales. And as post-sales you have less pressure. You no need to push for sales, right? But if you ask me to talk about pre and post sales first, right, you should always go for pre-sales, right? For the reasons I just mentioned earlier on, because the closer you are to revenue, the higher your chances of surviving. And I think you don't have to worry as long as you are a commercial engineer, right? Whether you are pre or post sales, right? Obviously pre is better. Hold on, I think that commercial engineers like SEs or post sales tech implementation, right? When I say commercial, it means that you are client facing, okay? So if you're client facing, right, instead of like the traditional software engineer, right, I think that you are safer compared. The reason for that is because of AI. Actually, it's all comes back to AI again. Because like with Claude Code and everything, right, the expectation is to cut a lot of software engineers and just have like a senior or very few juniors, right, and just have the AI do most of the work in coding. There's still hallucinations. Some of the code is still crappy and not the best performing, but it's just the new direction now already. I don't think we are going away from this new paradigm. But the reason why commercial engineers, right, whether you're pre or post sales, right, even if you're in SaaS, it's okay. I'll talk about that SaaS part later on. Is that when you're a commercial engineer, right, a SC or post sales tech, right, implementation, right, you need to combine elements of your commercial sense, your relationship, people element. That's also a skill, right? Because the ability for you to explain complicated technical stuff to your clients, to your partners, right, is a skill, right? And I find that a lot of software engineers, right, especially those that I interact with, right, they are very bad at this aspect, and now they're screwed because they always thought, oh, I'll just stay in my own cushy job as a back-end engineer or even a front-end engineer, whatever it is, just in the back, coding stuff. I'm really intelligent. I build great algorithms. You know what? All this doesn't matter anymore because Claude Code can ship code faster than you can. Right? You can check code faster than you can. Yes, there's some hallucination, but if you look at the grand scheme of things, the value that all these new tools are adding far outweighs the temporary weaknesses that it has, right? And I think that all these things will continue to improve. Hallucination will always be a problem, but because of the nature of code being verifiable at scale, right, you can write unit tests. The AI can write unit tests. It can, to a large extent, capture a lot of these problems. And I mean, even if without AI, you talk about the old paradigm of code. Even with people, there's hallucination. Right? People write buggy code, right? So I think there's a case to say that, the overall value add of AI will always far outweigh whatever human software engineers that was in the past. So anyway, come back to the point. Let me find a nice spot to carry on talking. Let's look at some stuff here. Coming back to the point, for the SaaS wise, right, I think that it really depends on what kind of SaaS companies you're looking into. So let me just divide all my answers to you in a few parts. The first part is that pre-sales always beats post-sales. If you can do pre-sales, try to do pre-sales. If you have no choice but to do post-sales, never mind, it's okay. It's a good start. But in your career, always try to move to pre-sales. Okay, so because it's safer and more secure, you get paid more because you get paid on commission. Because your whatever deals you close directly impacts the company's top and bottom line, right? So that there's a lot of reason to pay you more, right? Now, so that's the pre and post sales, okay? But if you have to choose commercial engineers, which can be either pre or post sales, over software engineers, I say always go commercial engineer nowadays. Unless you are damn bloody good at what you do. Maybe you are AI engineer, or you have certain specific niche, but even then I think it gets eroded away very quickly in this current AI age. Unless you're able to use AI so reflexively and so well that you are like a AAA star unicorn software engineer. Otherwise, I think it's very hard nowadays. So next, a question about SaaS, right? I think that it depends on what kind of SaaS company you work for. If you are in a horizontal SaaS company, let me adjust my. If you're in a horizontal SaaS company, so I name some names, companies like Salesforce, right? All these companies are very horizontal, like they are just a CRM company storing like sales processes. Yes, there is some login mode where they store a lot of the sales clients' data inside some of the workflows, but honestly, it's very basic, right? My company, we have, okay, so I cannot say which company I work for, right? But I'll just say in general, my company, we have rebuilt our own CRM, We kicked out Salesforce already. Yeah, so this is some of the reasons why I cannot say where I work for. But we kicked out Salesforce already, We basically replicated whatever Salesforce does, right, in 1 to 2 months, with AI, And so, like, we don't need Salesforce anymore, That's why I don't invest in Salesforce. I can really see what's going to happen already. Okay, but the kind of SaaS you want to be in, right, is you want to be in a vertical niche SaaS. So any niche, like for example, I don't know, your SaaS company works very, very deep into the advertising industry, maybe very, very deep into the shipping industry, or very, very deep into the e-commerce industry, whatever it is, you are a vertical niche. Or like for example, what's the company that I told you guys about? Viva, right? Viva is a very vertical SaaS into the pharmaceutical, biomedical industry, right? You want to go into this kind of vertical SaaS companies to work as a commercial engineer, whether pre or post, because the risk and probability of AI, right, disrupting all these companies, right, is very, very low, in my opinion. Okay, that's why a lot of these companies, right, I think they're going at very good value. This is a separate topic altogether, so I think the SCs, right, it's not about. Another part of your question is the SCs, right, solutions engineers, right, pre-sales, right, or post-sales, right, it's not about specific technology. Right, it doesn't mean you learn Java or you learn JavaScript or you learn Python or Go or whatever language it is, right? Then you're at risk. It's no longer about specific tech already. It's about how well your commercial ability is, how well you can communicate in technical language in simple terms, how well you can quickly use AI to learn new languages, or to be able to just build in whatever language is necessary, right? So the commercial engineer doesn't care. What commercial engineers care about is how to solve the problem. That's the most important. Yeah, it sounds very simple, but actually it's a very difficult thing. How to break down big problems into small problems and use any kind of programming language, right? So the specific tech, I think, really doesn't matter anymore. Oh, while I am walking, I by chance came across this Bvlgari Hotel. It is like super atas one. So I thought maybe let's go check it out. What actually looks like inside. I don't know if I'll be stopped from filming, but let's try. Let's see how deep this thing goes in. While I'm walking, let me answer the next question. What are your thoughts on dividend investing in local banks? Do you think their valuations are too high, or is it worth considering? Honestly, local banks are very strong. I think that the only chance that these local banks can ever crash is if our government crashes, because everybody knows there's a backstop. Like Temasek is major shareholder in like DBS and all these banks, for example. Alright, so it's more like the sentiment of the day, like whether or not there's a pandemic, like what happened to DBS stock crashing, and then like 2008, all these crashes. But I think local banks are just very strong. In fact, it is my own exit plan. Some of you know that once I reach my 50s or early 50s or so, I will very likely transition a lot of my growth stocks to local dividend paying stocks, just because I want more income instead of growth stocks. I might have a mix of both, right? The last I looked at the banks on a price to book ratio, I haven't looked at the banks for a while, by the way, because they're not on my radar, because I know that for sure I'm not allocating capital so early on in my investing journey. Look, there's a Bvlgari shop here outside the hotel. The last I looked at them, they were quite overvalued on the price to book ratio. But even if they are a reasonable value, the opportunity cost of me to allocate into the US is still far greater. So I never even consider that. Because of the opportunity cost of growth versus dividend stocks in general. Okay, but again, this is just really specific to me. A lot of it depends on your time horizon. Again, your risk and volatility tolerance. There are some instances where I advocated that you should just go for dividend stocks, or just go for ETFs, right? So a lot of it, because like you're getting cash flow while you're waiting, right? Even if you experience a capital loss, psychologically it's not that bad for you, because you are still receiving income while you're waiting for the capital position of your local bank stocks to recover. So I think this is really individual. Okay, there's no right or wrong answer. And yeah, But if you want to know, oh, hey, the hotel, is this the hotel there? Bvlgari? Eh? Oh, the whole complex is the hotel. This building is the part of the hotel. This garden, and then this ballroom area is also part of the whole thing. I'm in the hotel now. Okay, let's try to go in. Yeah. Okay, next question. Wow, this question. Budget bid very highly. I like you a lot more. I don't know how to comment on this question. I actually met her a few times. We did some filming together for. Wait, let me take a picture of this. Bvlgari Miss thing. I thought she's okay lah. Like okay lah. Where Holland? I don't know. I don't really care about all these things. I mean, I just make my content and just get over and done with lah. You know, and yeah, I don't know. She was very nice to me lah. So I got no comments about this. So maybe let me move on to the next question. Let's go inside the hotel first. 哎，你好。Wow, look at all this Bvlgari jewelry. The next question is, Europe is moving away from Visa and Mastercard, perhaps partially due to how easily they blocked Russia transactions previously. How does this affect your thesis? Let me just chill in the lobby here to answer this question. This is the Bvlgari Hotel lobby in Shanghai. Damn atas. I don't think I'll ever get to stay here. It's too expensive already. Wait, I'll find a seat somewhere. Oh, look at the sofa garden here. By the way, those of you that follow me on Instagram, you know that I stay at the St. Regis in Shanghai. Hey, this one all not my own money. By the way, some of you message me say, wow, Turtle stay very atas. Actually, all these are paid by my company. It's part of my travel expense. Whenever there's a chance for me to book a hotel and it's within the company budget, I just straight away snap it up. Otherwise, usually I stay more to your hotel. But so far it's been quite decent. The budget always allows me to book St. Regis in Shanghai, so it's not too bad. So anyway, back to this question. I'll tell you about Mastercard and Visa, right? Companies, once they reach this certain scale, right, they will always be a target one at scale, right? Even Meta, Google, they have all this antitrust, they have all this people trying to outcompete them to steal the transactions or to block the transactions, like in this case in Russia. The first thing, right, I want you guys to understand, right, is that this whole risk of Europe moving away from Visa and Mastercard, right, is not that much an issue for Mastercard because Mastercard's key market is actually cross-border. So it's not intra-European domestic rails, right? So this European initiative that I think this question is referring to, right, is the European Payments Initiative, which is short EPI. I believe it was kickstarted by the ECB president because the Europe is worried that, especially now with Trump at the helm, he suka can change his mind and use all these companies and tools to threaten all the EU or the global companies, right? The ECB and EU, like, they are worried that the US may suddenly switch off European access to Visa and Mastercard. But the thing is, this EPI, right, this Europe Payments Initiative, which is like an intra-Europe cooperation thing where all the local bank payment methods all collaborate, so they don't need to use Visa and Mastercard, right? These are mainly intra within EU. They are not cross-border, you know. They are not cross-border. Which is the higher margin portion that Mastercard focuses on, right? So for example, like I said earlier on, right, like EU people paying for USA Netflix or software, or EU people traveling to US, or US people traveling to EU, all these cross-border transactions that if they use Mastercard to pay, right, it is totally unaffected, right? Or the UPI in India, PayNow in Singapore, like they've been around for very long already. all these other players, the local players, right, that touch local payment infrastructure, none of these players, right, up to today, right, has dented Mastercard or Visa's growth. And Mastercard still continues to grow revenues in the mid-teens, around 15% year on year. All right, and even then, Mastercard is not complacent, because 30 to 40%, right, of Mastercard revenues, right, is VAS today, value-added service. So all your things like fraud protection, I don't dox myself. Let me just look down. Look at my reflection. All these things like VAS, like cybersecurity, fraud protection, etc., right, and data analytics, right. What I mean by data analytics is that people actually pay Mastercard, Visa, right, for data about consumption trends. Can you imagine, right? Because of the scale of Mastercard and Visa, right, they have so much intimate data of all the consumer behavior, where they're buying, what country is spending the most, what kind of products they're buying, etc., right, that if I'm a government agency, right, or if I'm just a private corporate, and I want to know, for example, okay, in Singapore, right, what is the highest grossing product now? What is the highest grossing department store now, right? If I'm a company, right, this data is so valuable, and who has access to all this data? It's Mastercard and Visa, right? So this accounts for that 30 to 40% VAS that I just talked about. Yeah. So Mastercard is not complacent. Even though the cross-border trade, cross-border transactions is not affected by all this EPI Europe initiatives, they are still investing a lot into VAS, so they are very diversified in that aspect. And again, anyway, if you ask me, my Mastercard position is a cash position. I'm ready to allocate anytime. All right, so I hope that answers your question. So now we're in front of the Shanghai Chamber of, is it Chamber of Commerce? Yeah, Shanghai Chamber of Commerce. It's actually right next to the Bvlgari Hotel, which is over there. But let me just answer this next question you have while I'm looking at this building. Are we in a bull market? What's your opinion? My gut feeling is yes. This is my gut feeling. I think the real larger market dynamic that is powering the entire market in the whole world now, the reason why the Taiwan market just exceeded the UK market, the reason why we are generally still, I'm still generally bullish, is the AI story, to be very, very honest. Like all this Iran war or all this Liberation Day last year, all this, I think it's kacang putih, to be very honest. Like really kacang putih. Like the rate is going, the Iran war, like ceasefire. Every few moments I read about it is another 2-3 weeks ceasefire. Before you know it, it's going to be exactly like last year, the Liberation Day, right? Where if you guys follow the news now, right, you know that the Justice Department basically deemed all the Liberation Day tax policies that Trump pushed out to be illegal, So now all these cross-border, like people from overseas, they try to sell to US, right? Then they have to pay all these taxes, right? They can claim for refund now, But the larger point of this, right, stepping back, right, or me bringing this up is that this whole Iran war and this ceasefire non-stop, right, I think it's just nonsense. I mean, I cannot predict the future, but looking at the way that Trump is handling it, right, and just comparing to the overall general bigger dynamic that's really at play here, which is AI, I really think the Iran war is lesser in terms of like impact compared to AI. So if you want to ask me when it really becomes a very bad market, is if there is an AI bubble and if that bubble bursts. That is probably going to be equivalent to the 2008 subprime mortgage, because the amount of capital that is invested across the world now into infrastructure, into buying chips, building data centers, generating power, etc. is so fucking huge, man. And it's going everywhere in the world now. Like I visit KL a lot because my wife's family is based there. They just basically changing a lot of forests, raising it out and then replacing it with data centers, So it's quite ridiculous. And then, I tell you guys, anecdotally, I've been coming to China for work for the last, I've been in my company for 5 years. I've always worked in the Greater China region. Do you guys know, right, that the last few days I've been here, right, in Shanghai, right, I've never encountered this before, but I swear to God, right, every restaurant I'm eating at, right, the table next to me, right, I don't know whether they're in technology or what, okay? I can't be that coincidental, right? Everyone, right, mentions the word AI, it's fucking scary. Like, I was eating at a dinner restaurant yesterday, right? And I overhear this person as I walk past, and then I sit down. They're saying, "Oh, you know, at our company, AI is doing this and that." And then the day before that, right, I was eating the Peking duck, right, and then I experienced the same thing. The table next to me talk about AI again. Then I walk to the toilet, right. The people I walk past, right, they talk about AI and saying that AI can do this and that at their work. So, right, I think that this entire AI narrative, right, has truly captured the entire mainstream, like, mind share already. It's fucking huge now. So, it's so huge that, right, if there's any bubble breaking or if there's any existence of bubble, right, I think the impact is going to be, it will rival the 2008 subprime mortgage. Yeah. So, I think that is the real indicator of whether we enter a real hell of a bear market. But for now, I think we're in a bull market lah. This is just my take lah. Okay. Alright, so I walked a bit further and I'm along the Suzhou River here again. Now, if you guys look at the far horizon there, that thing I'm pointing at, that is the famous Shanghai Dongfa Mingzhu Ta, right? So this tower there, it's so the area over there is the Bund. So this river is like our Singapore river like that lah. It connects all the way to the Waitan Bund there, where all that side is what we call Pudong. And then this part here in Shanghai that I'm standing at is called Puxi. Wow, this one must pronounce properly. Don't get into trouble. Cannot put kid label. So this one is Puxi. That one is Pudong. Not foul language. So we're gonna start walking there. Anyway, the next question is, do you invest in REITs? The answer is no. I don't invest in REITs. I don't invest in REITs. My idea is, if someone is investing in REITs, it means that you're going for an income play. And for me, if I reach the stage that I want income from my passive investments, I would rather prefer to invest in local bank stocks for dividends. That's just me. Yeah, because it's just personal preference. I don't really like how I think firstly we are in a new environment now where I do not think that we are going back to the zero interest rate policy days, the ZIRP days. I really don't think we are going back there after 2022 until now. And with the Iran war going on and oil being so volatile like this, I think the Fed's position is to keep rates as high as they are, where they are, and not to cut too drastically in the future. I don't foresee that happening. But I mean, these are very short-term macroeconomic predictions I'm trying to make, which I think shouldn't be something that we should do. But I just don't like the way that REITs are, apart from this macroeconomic sensitivity, I don't like the way that REITs are structured in the sense that there is no reinvestment of capital. What I mean by that is that there is how many percent of that, of the profits has to be returned to REITs holders, right? The distribution. So I don't really like this idea because I don't believe there's a free lunch in the world, right? If you are forcing all the proceeds and income to go to be distributed to one sec. Oh, it's a carnival here. If you are forcing the income to like you must distribute to all the REITs holders, right? It means that there is less opportunity to reinvest all this, right? So like I always believe that in order for a company to be nimble, right, there has to be a reinvestment pathway, right? There needs to be an opportunity or possibility for a company to keep reinvesting, so that it will continue to be nimble, it will continue to develop new stuff, become better, right? So I think with property, I guess there's a constraint there because like how much can you develop, right? In other words, you're just developing new properties and making your offices better. Like there's a ceiling, right? So I think a lot of it is really got to do with the nature of the industry of property, or property management. So for me, it's not ideal lah. Yeah, at least with the banks, for example, like DBS, right? Even though they pay out a portion of their income as dividends to shareholders, they still keep some of it for reinvestment, right? So for example, you see digitalization, right? DBS starting to look a lot into AI, starting to look how they can reduce their headcount so that they can be more efficient as an organization, right? So they can take some of that income and reinvest into all this technological infrastructure so that their future income becomes even better. So I think this is a much more nimble and more sustainable route rather than just paying off everything like REITs. Alright, so for me, I don't invest in REITs for that reason. It's the lack of a reinvestment pathway. Unlike the banks, yeah, which has some investments. Okay, I'm gonna carry on walking to the Bund. So I'll see you guys there shortly. We have arrived at the Bund. That is the in Chinese we call it the Shanghai 市人民英雄纪念塔. So it literally translates to this structure here translates to the Shanghai People's Hero Tower. Like it's a memorial structure lah, probably for the war effort and all that. But this is the Bund. We are still standing on the Puxi side of Shanghai. So then that over there is the Huangpu River. Then the other side there, that's the Dongfang Minzu Ta, right? Very famous broadcasting tower. Then so this is the Bund, that's like the most famous part of Shanghai lah. So I'm going to answer the next question while I'm just chilling here lah, because I'm quite shacked actually. Doing AMA while walking is quite a lot of effort, filming and looking at the questions and everything. So the next question is, how do you find the will and discipline to restart your life at age 31? You say that you are currently struggling to find your purpose in life and you are suffering from constant lack of motivation, right? I think I shared about some of the reasons why in the last AMA, but I can talk a bit more lah. Maybe we've come to this part of the video. I think the people who really watch all the way until here, you are quite dedicated viewers, so I really appreciate all the time that you guys have been giving to follow. The last time I just said that 8 years ago I just had no money lah, right? Like start from rock bottom. And then I told you guys that I had no money, so I was very pressured to make everything work, right? Like my career, my work, how to improve myself, right? So how did I restart my life at age 30, 31, right? Actually, apart from that, there were other factors also. I didn't tell a lot of my friends. I think only very few people. I can count in one hand. People know, but my relationship with my mom is really bad. There's a whole another story about that. But during a lot of my life, there was a lot of threats where she wanted to kick me and my wife out of the house. Yeah, it's quite drama lah. Anyway, so it happened a lot of times lah. I think the final straw came in my early 30s lah, and me and my wife just felt that we didn't feel very safe at home. So like anytime there was any disagreements or anything that she wasn't happy about, my mom wasn't happy about, then the house would be used as a threatening tool lah. So me and my wife would be pressured to kick out. There were a few times I actually moved out. Yeah, so me and my wife, because of that, we had to actually apply for BTO, which I think was the best decision we ever made to move out lah. Yeah, so there's a lot of family issues lah that I had. So that's one thing lah. I had the pressure of having to move out and then rely on myself lah. And there was a constant threat of kicking me and my wife out. And my wife really followed me for like more than 10 years. And after we moved out, while we were waiting for the BTO, right? Because BTO like takes time to build, right? Obviously, I could no longer live in the house lah. We actually rented a very dingy apartment, like a very small kind of studio lah, very 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 small, and it's not like the atas inside a condo kind. It's like above one of the very old shop houses kind of. Yeah, so we stayed there for actually many years while we were waiting for BTO. It was quite a difficult time after I got kicked out, or rather I voluntarily left the house Yeah, because of a lot of struggles at home I think these struggles and everything, maybe I will go in even more detail next time Yeah, it's just a lot of emotional trauma But anyway, I didn't want to let my wife down because she literally followed me all the way from when I was, spoiled Asia rich boy driving BMW, then downgrade to a Toyota, then downgrade to no car, take bus MRT, right? Then from condo become no condo, everything. Yeah. And then now kicked out of the house, and then rent a dingy place, very cui, right? Yeah. So I didn't want to let my wife down, honestly. So I really pushed myself to work very, very hard. My income grew a lot during the years that I was waiting for the BTO. So actually the truth is, right, before I got the BTO, right, when I'm applying for it, right, they look at income, right. Me and my wife combined, we were very fortunate. We started very early in our career, then we managed to grow the income a lot. So right now, today, when we live in the BTO, we are very, very comfortable because the salary basis that they assessed us, we qualified, right? And then over the years, we grew a lot, and then we are living in a very affordable BTO, while having a high salary combined, right? So that's something. But anyway, coming back to your point about finding the will and discipline to start. Just to summarize so far the points I talked about. The first one was that we had no money right? So there was a constant pressure for me to better myself and have the will to really restart my life. The second thing was that there was a pressure that I was constantly getting threatened to be kicked out, right? So I just had to find my footing somehow, right? Yeah, when you feel like you're gonna die, you figure a way out Then the third thing is I didn't want to let my wife down. Yeah, then about the point about finding your purpose, right? I think one incident I'll share with you, but it may not happen to you but I'm just letting you know my version is that a few years ago I made an episode, right, about my this auntie, right, based in China. She's from Shanghai, right? She developed like liver cirrhosis, right, like cancer of the liver or whatever it is. And then I saw her from a full walking human, healthy, to going to the deathbed ICU and then dying within 2 weeks, Yeah, so she's normal, eating McDonald's and everything, then next moment she's just dead, Then at the funeral, And then it made me realize that, right, that Steve Jobs had a saying, right, that every day, right, when you wake up, right, you should look at the mirror and ask yourself, if today is the day you die, right, will you be happy doing the things that you are doing? Yeah, so that is something that I ask myself every day. That's why I'm so motivated to build stuff, right? I'm so passionate about building this YouTube content channel because I think this is something I will do for a very, very long time in my life. And I'm very happy building this channel and doing content for Singaporeans about personal finance, about life in Singapore, about our hardships, about the unique challenges we face as real Singaporeans. Yeah. So the thing is, I realized this idea of time is really, really short after seeing what happened to my auntie dying so fast. And I told myself, wow, if I die tomorrow suddenly, let's say I got terminal illness, I gotta make sure that everything I'm doing every day now is really what I want to do in my life if I'm ending So I'm not telling you to stress yourself out saying that, oh, you're gonna die tomorrow, or just pressure yourself saying that, is this what you really want to do? Is this really what you want to do if you are dying, right? But the idea is to ask yourself if what you're doing, if today is the last day, or is this, or maybe another way to ask is, could you foresee yourself doing this every day for the rest of your life, whatever it is you're doing, your current career or whatever it is? If it is not, right, I tell you, my advice to you is, right, you should start to proactively figure out a path to whatever it is you want to do, right? So if you're stuck in a dead-end job, right, and you have no motivation, right, or you have no job, right, then every day you wake up, you ask yourself, right, at the end of the day, at night, right, before you sleep, right, you ask yourself, have you achieved what you need to achieve today? Yeah, so you should set mini goals for yourself every day, such that every day, right, you are moving at least 1% towards your target, whatever the target is. Your target could be, I don't know, become a YouTuber, It could be entering the finance industry. It could be, I don't know, become technically better, so you become a tech engineer, whatever it is. Right? Are you laying the brick every day 1% at a time? You don't have to be 10% leaps and bounds every day, Every day, right, I ask myself the question is, have I moved the lever in my life today towards the direction I want to go? So like for today, right, my 80-20, right, to determine if my day today is a success, right, is filming this vlog. So filming this vlog, right, now it's like 6 p.m. already. I started filming since lunch at 12. It's like 5-6 hours, right? So this is my majority of the day, right? So you need to ask yourself every day if you ship what you need to ship. And there'll be a lot of distractions along the way, by the way. If you work a day job, right, you wake up, you take MRT, you go to work 9 to 6, right? Then you pang gang, you finish work, right? You might be too tired. That's why I say you to start from a place of passion. Whatever it is you want to do, right, yes, it is something that you really are so passionate about that even when you have a lot of money, right, you still want to do the thing that you're doing. So that after work, every day when you pang gang after work, right, you will still be motivated to work on it a little bit. Yeah, so sometimes even when I'm very, very tired after work, sometimes I really work OT until like 8, 9, 10 p.m. I still spend at least half an hour or 1 hour building whatever it is I want to build. So like building this channel, right, maybe I might spend 1 hour thinking about the thumbnail or thinking about the title of the next video, right? Or starting to write the script for my next video, right? Or so I have another concurrent project now, which is I'm trying to build a mobile app. Or maybe I spend 1 hour just coding with AI on the app, right? Even 1 hour every day, right? On a very bad day, right? So you have to move small steps, but every day as long as you're moving consistently, you will get there. So if you're struggling, right, you feel unmotivated, right, don't pressure yourself to take big steps every day. You take small steps every day, it's fine. Yeah. Okay. And then remember to start from a place of passion. Okay, the next question is, have you ever regretted not spending money on something because you were too focused on investing that amount at the time? I tell you, the answer is unequivocally no, right? So yeah, this is great, right? This ties into the last question. Like every day I ask myself if this is how I want to spend the day. Every year, a minimum, I spend at least 1 to 2 holidays per year, right? With my wife or even sometimes even by myself. Yeah, but these days a bit hard got a kid already, like a lot of responsibilities. But I try to at least plan with my wife. So like tomorrow night I'm actually flying to Seoul. That's why I'm gonna film the second vlog AMA in Seoul, the Turtle Finance travel finance in Seoul. I don't regret. Yeah, I do balance it between investing and spending money. Yeah, so I believe in this philosophy of smelling the flowers along the way while you're growing up. And you know, the reason why I'm able to do this is really, really simple. I've said it in a lot of my videos, right? Me and my wife, right, even myself, we are, by myself, my own salary, income, everything, we are more than capable of affording a condo, I can literally buy a condo. Tomorrow I can go and make a deposit. I can get a condo, right? But I choose not to. You must understand, this is not because I'm forced into, he's forced into buying a HDB. It's not, I think people have the wrong impression, me and my wife can really more than afford a condo. We really can, but we choose not to, right? For 2 reasons. Number one, we have a huge margin of error for our financials. If we lose our job, right, tomorrow, right, we really have no sweat at all. We can survive for many, many years. There will be no problem. I cannot say the same for a lot of Singaporeans that are in just nice financing situations where their mortgage takes up a significant percentage of their salary, right? Plus all the other expenses that they have in their life, maybe with a car, right? So for me and my wife, right, we have no condo and we have no car, And so we have a huge margin of safety in terms of financials, number one. And so number two, right, because of that, right, we have tremendous flexibility. And so because of that, me and my wife, right, whenever we want to go holiday anytime, right, we are able to go anytime. I can go like 2, 3, 4, 5 times, how many number of times holiday a year, it really doesn't matter. And we can go to like any restaurants. Any weekend we just decide, oh, this weekend let's go to a Spanish restaurant. Next weekend let's go to a Japanese omakase. There's no like, we don't pause to think. We just go. Yeah. So we can do this because we have already we have already sorted out the 80-20, which is a condo and the housing situation, which is very, very affordable housing, and the car situation. Because she works in the CBD, and then I work remote. So why do we need a car, right? The only exception we need a car is when my kid grows up to a couple of years old, and then maybe we want to send him to some fun swimming lessons or enrichment or whatever shit. I don't know what they do nowadays, where there's a lot of ferrying back and forth. So the taxi becomes uneconomical, right? So then yeah, maybe in that situation I might consider a car. But now we really don't need a car. My wife just takes the MRT to work, because in the CBD you drive in there, you park there, it's kind of insane, right? It's kind of stupid also, right? Yeah. So to answer your question, I have not ever regretted not spending money on something because I was too focused on investing. And I hope that you guys can have the same amount of balance, because there were a few viewers that message me, right, or leave me comments saying that we get into arguments with my wife because we realize there's an opportunity cost. If I go for a holiday with this however $1,000 that I spend, then that means I'm losing on how many percent of returns in this bull market and that stuff like that. So I think that is yeah, don't do that. You have to have a balance. Yeah, don't compromise your happiness index for this kind of I know that I always say delay gratification, and Warren Buffett also preaches that, but I think there should be a balance. Okay, the next question is your research effort. Why not consider higher risk and reward stocks? Risk mitigated by research. I would think white mode mega caps are for people that buy and close eyes. I think the first thing is, with risk mitigated, I would think, why not consider higher risk stocks? I think the first consideration is really circle of competence. I start from circle of competence first, or whether I understand the company. I think I begin from there. So it's not really a matter of risk and reward. It's whether I understand the company first, and then I start to think about risk and reward later. And then you say here, I would think white mode mega caps are for people that buy and close eyes. I would disagree with that. Have you seen my concentration? Do you know that if you look at my portfolio earlier in the video, nearly 40% of my portfolio is in a single stock, in Meta. It is a white mode mega cap lah. But have you heard of anyone that invests? Okay lah, I know that there are some people in Nvidia, sorry, the wind is quite strong. I know there's some people in Nvidia, they invest like 60-70% lah, but like not many people do this kind of concentration, I think most people will be quite afraid to have this level of conviction and concentration. I would say. Yeah. Wow, the wind is really strong. I hope you guys can hear me. Yeah, so I would say with this level of concentration, I don't think people will buy and close eyes, I'm pretty sure people who buy and my concentration will be opening your eye to check every day. So I beg to differ. The next question, what key tenets and life principles will you teach your son or daughter when they come of age to start investing? Okay, there are a few things. There is this maxim I really like that is from the US Navy SEALs, and then Jeff Bezos also quoted it quite a lot, which is slow is smooth and smooth is fast. I don't know if you guys have heard of this. Right, I say again, slow is smooth and smooth is fast. And I like to add a twist to this saying. I like to say slow is smooth, right? And smooth is suddenly fast. If you look at the investing curve, right, it is very, very slow at the start. It is like a flat line plateau, right, at the beginning, for maybe it might even be a few years. And then suddenly, right, as you start compounding your investment portfolio, it gets bigger and bigger. It becomes exponential, right? Because it's a compound growth rate, right? Right. So if your example, let's say your portfolio grows at 10%, just roughly, right? Over 10 years, right? It's 1.1 to the power of 10. It's not simple interest rate. right? So because of that, investing has this exponential thing which is slow at the start, right? But then suddenly fast at the end. So I think this is one of the maxims or philosophies I want to teach my kid, which is when you're doing investing, right, it will appear to be very, very slow for very, very long, but you have to remain disciplined. You have to be very disciplined in your conviction, in your thesis, and continue to monitor your positions. And then before you know it, right, after you've been patient for many, many years, right, you will be suddenly rewarded when the curve starts to go exponential, right? Hence the saying, slow is smooth, and smooth is suddenly fast. I think this philosophy also applies not only to investing, but a lot of other things in life, right? When I built this YouTube channel, right, the first few years, right? The first few months, right? Nobody watched my channel, but I kept plowing at it. Wow, so many people! Holy shit! Look at this. What the fuck? Everybody's just sitting on the stairs. Nobody looked at my YouTube channel. Yeah, but I kept going at it for very long, right, at the start. So it's like a plateau, right? Then suddenly after one video, it exploded, right? So I realized this phenomenon happens everywhere. You just have to keep going at it and be very disciplined and have a very long-term view. Wow, there's so many people here. What the hell? Yeah. That's the first thing. So slow is smooth and smooth is suddenly fast, right? For investing. The second thing is a principle called how do you pronounce it? Occam's razor. You guys can go Google it or Wikipedia it, okay? It is one of the central mental frameworks I have in investing. Occam's razor. What is that? It basically means, right, keep it damn simple. Right? Occam's razor says that the simplest path is usually the correct path or the best path. Okay, so right, when it comes to investing, how do I apply that? You know, when you talk about a company, let's say like Exxon, everybody like to throw missiles at my position at Exxon, especially now the stock price is so down. Easy to feed on the bad narrative and hantam me. But let me just use Exxon as an example. Okay. Sorry, one sec. So with Occam's razor, right, you are really being very simple and focusing on the few things that matter. Exxon, right, you can keep researching it and you can find 20 reasons why it is good or why it is bad. Right, 20 reasons. Right. The point, right, through Occam's razor's philosophy is you just need to focus on the small number of things that really matter the most, the 2 or 3 things that will move the needle and ensure that the company continues to survive and sustain high growth rates, right? Return on capital for very long. So that's what I mean by Occam's razor. So rather than obsessing over every single small little detail, thinking that it will move the needle in the wrong direction, I just focus on the few big picture things and ask myself if the company will carry on growing as it will. I'm gonna exit here because there's so many people already. Go down to the road there. I think less people. Yeah. So Occam's razor is really important. Yeah. So focus on the 2-3 things that matter the most for an investment, because everything else, right, honestly, is just gravy. And I'm not saying totally ignore them. I'm just saying that you cannot miss the forest for the trees, Yeah, don't let a few small things like affect you. Like one of the questions later I will address, I saw somebody asked me something about Exxon. Am I worried about the Epstein connection or something? It's like some very far-fetched connection. Like I thought by that logic, there are so many things linked to Epstein. Then doesn't mean we just don't invest in everything. You know what I mean? I think that you really need to spend and focus your time on the few things that matter the most. Yeah, so like skin in the game, that's really important. You know, things like what's the installed base of Exxon, right? It's 90% of the body cam and the taser market. And then a simple question I ask myself, will that get disrupted tomorrow or in 5 years or 10 years? I can tell you conclusively the answer is 100% no. it is nearly impossible. So even at whatever crazy stock gyrations that's going on now with the price, right, I'm honestly not afraid, because I know that tomorrow, in 5 years, or in 10 years, the installed base of body cameras, installed base of tasers across law enforcement in the US, 90% coverage, will remain exactly the same. It might even tick up even more, right? So that gives me a minimum threshold of safety. I know this company will survive. There is a moat. That's why we define it as a moat, right? So you really just need to focus, Occam's razor, be very simple. Instead of 20 things, go and figure out what is the top 2-3 things that really matter the most, and focus on these 2-3 things for your long-term thesis. The rest is gravy. Once in a while you gotta check the gravy lah, because sometimes of course the gravy can spoil the entire dish, right? So I'm not saying be complacent, but I'm saying don't miss the forest for the trees. Yep. The third thing is don't sell early. Learn to delay gratification. This is the hardest part when you're doing growth investing. When you're doing dividend investing, right, it's not so bad. Imagine if you're fully invested in DBS, right, as a dividend stock, right? Right. There's a case very easy for you to say, oh, I'm not going to sell a single DBS shares. Why? Because every quarter, DBS, when they report earnings, they are issuing, dividend income. If I sell my DBS shares, I'll get less income. So with this kind of philosophy, right, it is easier for people not to sell out. They just hold the DBS shares. But what if you own a growth company like Meta? You own a growth company like Exxon, right? Meta pays dividends, but it's like inconsequential. It's very, very small. It's mainly still a growth stock, right? Or you hold a growth company like Amazon. Then the reasons for you to delay gratification are very hard to maintain. Because today, right, for example, Exxon is a good example. I always keep going back to Exxon. Exxon went all the way up to $900. So my unrealized gains at one point, right, my position, right, tripled, on an initial cost basis of 290, before I averaged up. I started with 290, right? At one point, my initial position of 290, which is quite a bit of money, right? It tripled, And then the next few months later, because of the whole SaaS apocalypse and then the acquisition of Carbine, right, the stock went all the way, crashed down to 390, 400 plus now, right? And so there was a huge gyration in terms of the unrealized gains and loss during this period. So anyone, right, during this period, right, the amount of emotional trauma that you get, right, while holding onto a growth stock position like this, right, is insane for a lot of people. But for me, I have totally zero. It didn't affect me at all, because I am very dead set on what happens to this company in 5 to 10 years time. In fact, 10 years time. I intend to hold this company for at least a good decade. Yeah, my thesis hasn't changed. Of course, barring changes in my thesis, if there's a mega red flag that I spot that changes the thesis for Exxon or any other company, not just Exxon, I will sell the company, right? If you guys want to know the best example of this, is TTD, the trade desk. I sold out of this company, 2 years ago, at $80, $90, and I escaped. It's now all the way at $20-something, because I do not believe that TTD has a long-term sustainable moat. Because I work in the advertising industry before, so I understand that as a middle DSP player like TTD, right, it's very hard to justify a moat that is easy for the market to understand also. Because it's just a middleman ad player, it just aggregates demand for the trade desk, TTD. Right? So when you have all these players coming in now like Amazon DSP, right, which is a far stronger moat because Amazon can control and supply their own inventory, right? Right, so that was the reason why I sold TTD, right? So you have to be very clear why you sell. You should not sell just because the stock goes down and then you hear all the hearsay and people scared and panic, and then the price goes down and then you feed the bad narrative. No, you should only sell when your objective thesis changes. So my objective thesis on TTD changed because initially I had the impression that, oh, TTD looks very, very strong financially, and I thought that they had a moat because they were doing a lot of things that were in the what we call the open wall advertising market, which is beyond the walled gardens, right? So I thought they had a moat, but I was wrong. When I analyzed that, I realized a couple of years ago at $80, $90, I bought in at $80-something. Imagine I bought it at $90, I think. Imagine I sold it at $80-something. So I lost just like few $100, like no big deal, right? So I sold TTD, right? If you look at it, the price had nothing to do with it because I only lost $100+, nearly break even, right? So why did I sell of it? It's because my thesis changed, right? And so now with Exxon, right, it's come all the way down, similar to how TTD has come all the way down, right? If I had held TTD until today, right, let's imagine if I still hold TTD in my portfolio, right, I will sell. This is just me, I'm not a financial advisor, I'm just saying. I just deem that, I do not think that they have a long-term moat that's sustainable. But for Exxon, why did I not sell? Because their moat and the installed base across law enforcement is still intact. The thesis has remained totally unchanged, right? And I believe that their growth rate will continue to persist over 30% or over high 20s% as they expand to international, as they expand to enterprise, right? And then next year with the distribution of what's the Exxon taser thing, the one that the moonshot thing, the Apollo darts, right? Next year it's been a bit delayed. It's going to come in next year, right? There's a lot of optionality catalysts that come in. So you're back to my third point, right? Is don't sell early, learn to delay gratification, and this is extremely hard with growth investing, but easier with dividend investing. And this is something I will teach my child in the future, right? And all other things, how to delay gratification. Yep. The next thing is I want to teach them, my son, is to view owning shares, right, as owning a business. And this exactly ties into the point I just talked about, which is so difficult. A lot of people get married to the stock price, right? For me, right, when I own a company like Exxon, right, even the price coming down, right, I have totally no qualms owning it because I'm very confident in owning a piece of the business. The business continues to grow its revenues. The business continues to have a strong installed base and a moat, right? I'm a business owner of a valuable business that will continue to persist for many, many years. I'm very, very certain of this, right? So you have to view owning shares from that perspective. Not like a lot of people message me, say, oh, buy at this price, let's sell at the price. But then in between all this conversation, I do not hear a single thing about them talking about the fundamentals of the business, about the business model, about the products they sell. That should be the correct conversation you should be having. Yeah, so you must really learn to dissociate the share price with the business and focus on the business. The next thing is I would tell my son to be, or like people in general, like investing is exactly what Buffett says, is you want to be contrarian and to be greedy when others are fearful. And this is extremely hard to execute because in today's market and in last year April Liberation Day, I can tell you most of the people, right, were totally uninterested in investing. When this should be you should think opposite. Like you should think, oh my god, you're very happy that these prices are coming down, depressed, and then you can fire a shot at good valuation, right? You must have the kind of contrarian opposite thinking. You cannot be afraid to go against the status quo. Usually, right, I tell you the best opportunities, right, is, who is this? Chen Yi. Wow, my Chinese history sucks. I have no idea who that is. The best opportunities, right, is when most people, right, disagree with you. I can tell you that. Or when the market disagrees with you, right? I can tell you that is the best opportunity, right? That's why I made the most money in 2022, 2023 when the market was crashing, because that was the best time I could buy positions, right? And then I think maybe one more thing is the hardest thing with investing, right, is doing nothing, right, for very long. Nothing for very long, right? Meta went all the way up, a lot of money. I didn't even realize again. I carry holding on to it. I'm doing nothing. I'm just holding on to it and doing nothing. Just buying more. Exxon go all the way up 300%, come down now to $300+ from $900. I do nothing. I'm just holding on, right? I think that is the hardest thing in investing. How to do nothing. Yeah, investing is like a very ironic activity where sometimes the less activity you do to it, to your portfolio, right, the better your portfolio performance in the long run. Yeah. And then maybe my final advice is maybe don't share your portfolio with other people. Sometimes the stress does get to me. I try to be a bit more numb to it. Like when I show my portfolio numbers on my thumbnail or in my episode, people will always comment about the short term. Oh my, you lost $100,000. Yeah, you're wrong about that company, Or like when I don't update the portfolio, people will ask, oh, please give us an update of the portfolio. So I realized that I really opened the Pandora's box already. Now everybody is addicted to figure out, oh no, how is Turtle's portfolio doing now, I want to have a peek, and then so that, yeah, so I think sometimes there are certain moments in time it does affect me a little bit, but I don't pull the trigger to do anything stupid right? I just maintain my composure and just carry on my thesis. So I think it will be easier, right, if you don't share your positions Yeah. Okay, let me just carry on walking now. I'm gonna carry on walking. There are some pretty cool, nice, Renaissance-looking buildings here. I think this is. Can you guys see this building? This building, I believe, is Heping Fantian, Peace Hotel. I think it's this building, right? Am I correct? Yeah. Wait. Sorry, I'm wrong. I think it's that one. One of these buildings. I don't know. But anyway, it's a quintessential Shanghai hotel lah. Heping Fantian lah. If you guys are here, you should just take a look. But I feel like the hotel smells like pee lah. I don't know what perfume they use inside. It smells like pee lah. I'm not gonna go there lah. Okay, what's the next question? Let's see. Now that you are using Claude Code, do you still believe there is an AI bubble, even given the ongoing hallucination problem? Okay, I want to admit I'm a bit half now. I've been using Claude Code a lot at work. You know, in my whole organization, right? In my division at least, because I work in partnerships, right? I am ranked number 4, you know, in terms of token usage, you know, burning tokens with Claude Code, you know. I'm ranked 4. Yeah, so I burn a fuck ton of tokens at work. But I'm not burning for the sake of burning. I actually build stuff. Or I use it to query stuff and find answers. And I built a couple of apps. I can tell you that it's amazing. And it's really because of Claude Code, right, that I'm starting to build a mobile app now on my own with no help. Last time I damn lazy for like many years. I had this idea I wanted to build. I'll share with you guys soon. But now with AI, right, I believe that as a solo developer, I can literally build a whole business by myself. I actually think it's possible now. Yeah, so I think Claude Code is fucking good. The problem is that hallucination, right, cannot be solved. I'm still very sure about it. Because my outputs, right, whether it's building an app or whether it's finding answers, right, there's still hallucination. And just given my understanding of the architecture, I don't think hallucination will go away. But it will just be reduced. It will just be so useful and impactful that you will be able to manage the whatever hallucination. And you know, that's why you need some domain expertise. Going back to the earlier point. Right, so why I can very quickly verify, because I have some engineering background, some technical background. So I know whether whatever output Claude gives me, whether it's rubbish or whether it's reasonable before I use it. Yeah. So that is something that is very positive where, you know, I'm starting to think maybe am I a bit wrong, where even despite of hallucination, the ability for Claude Code to do so many useful stuff, building apps, finding answers and all these things, actually I'm using it at work. It's really quite impactful and it saves me a fuck ton of time. Things that will never be possible. And I don't think I can go back to the past where there's no AI, I tell you. That's how dependent I am on AI nowadays. Yeah. Yeah. But I'll tell you what are some of my concerns, okay? Being such a avid user of AI and Claude Code and all that, there's a huge phenomenon going on in the tech industry now called token maxing. Okay. It is still ongoing. It is happening in my company. So the best example is, you guys know, like in Meta, right? There was this thing where they had a leaderboard, right? And then all the engineers in Meta are scrambling to burn many tokens so that they appear that they are using AI reflexively, like as a second nature, right? So that maybe they won't get fired or maybe they get promotion or whatever. It's like, it looks good nowadays in tech not just in tech if you're in any company you say that you use AI wow, everybody worship you like some god like that I think this AI coolly thing needs to go away Okay, but anyway, it's created this situation called token maxing, right? What token maxing is, right, is like what happened in Meta, right, and happening in my company also, right, is that a lot of engineers, right, a lot of people, right, are burning tokens for the sake of burning tokens so that they look good on the leaderboard, so that they get promotions, so that they look good in their career. I tell you, this is very, very dangerous. This is precisely the kind of thing, right, that is building a bubble. I can tell you that my company, right, token maxing is happening a lot. People are burning a fuck ton of token, right? And then some of them, when I look at the tokens they burn, right, it's ridiculous one. I don't know what they're building. Like when I look at the things they build, right, I cannot figure out how come they burn so many tokens. Is it they use it inefficiently, or are they using some looping function to just keep scheduling token burns and calls and keep building random shit that doesn't really help work one? Right. I'll tell you why this is dangerous to the whole industry now, token maxing. Because if you're Amazon, right, AWS, right, right? Or if you're all these big tech companies like GCP, Microsoft, and AWS, they're supplying compute, right? And then you see all this compute getting burned, right? And then you're thinking, wow, the demand is damn high there. And then TSMC starts building a lot of compute capacity, right? Recently, they just announced they're expanding capacity again, right? Because you think that this demand, wow, is really damn solid, it's sustainable one. But little did you know, right, that a lot of this burning, right, of tokens, right, is artificially people who are token maxing, right? So token maxing is just people burning tokens for the sake of burning tokens, but not really doing productive stuff with it. I believe this is the beginning of some kind of a bubble now with token maxing, and it's across the board. Look at Uber. Uber also recently reported that their engineers blew through the budget in within 1 quarter or half a year or some shit, right? I'll paste this report here. Hopefully you guys should see a screenshot here right now. So that's token maxing, you know. I tell you, this shit is going through tech now, and it's just the way it is. When you have a leaderboard, right, or where AI becomes the craze now, right, everybody tries to burn as many tokens as they can so that they look good for their career. And then this trickles all the way to the metrics when you're AWS, GCP, or Microsoft Azure, and you see this huge amount of tokens getting burned, you build even more compute capacity, right? And what happens? You are overbuilding ahead of demand. The real demand, right, is actually not that high, because maybe half or whatever percentage of it, right, is fake rubbish demand that is being token maxed. Yeah, so that's one concern I have. I'm closely monitoring this thing. I think it's so hard, but I really think this token maxing is starting to proliferate in the whole industry. Yeah. The second problem I have, right, is there is a margin issue. There was a report from MBI. I need to figure out, I'm going to dig through the article, but there's a report that says that a lot of these AI frontier labs, right, like Anthropic and OpenAI, right, they do not include the cost of training AI models, right, new AI models, right, into the cost of goods when they calculate the gross margins. So Anthropic has something like 60% plus gross margins, but this does not include the cost of training new AI models, you know. So MBI, right, which is this bank analyst that writes a very good newsletter that I subscribe to, right, he wrote that this is not the correct practice, because in order for these AI products like Claude 4.6, 4.7 now, or GPT 5.5 now, right, to remain competitive, right, they need to keep pushing up newer and newer models, which means, right, this whole cycle of training AI models, right, will always be an ongoing cost at the cutting edge. And so by right, they should factor this into gross margins. So when they factor this in, right, it should be a lot less than 60%. Now, this thing, right, will not come to light, right, until, right, Anthropic and OpenAI, right, go public. Which is why in my last video I said, if there's ever a time when there's really an AI bubble, right, because of token maxing and all this shit that's going on now, right, people building ahead of actual demand, right, is inflated demand, right. If there's actually an AI bubble and it bursts, right, I think the precipitating event, right, will be the IPO of these companies. Because when OpenAI and Claude, right, when their numbers really finally come out, right, because all along, these are all estimates, you know, all this MBI report, all this the information article report, 60% gross margins, these are all rough estimates. Nobody knows the exact correct numbers for all the margins, the net profit margins, the whatever lah, all the margin profile. Nobody knows. Everybody can only guess only, roughly. Okay. So, but then when they go public, right, all these numbers, right, must be totally reviewed in detail. They must get chartered accountant, right? The SEC will check, right? So when people look at these numbers, right, later on, right, and then they realize, right, that the margin is not actually 60+%, right, it's less, right? And then they're burning a fuck ton of money, right? I tell you, at that point, right, the market may do a re-rating. When that happens, we may have a mini crash. But I don't know, I'm just saying, okay? Maybe I might be totally wrong, What if later Mythos, the legendary Mythos model that Claude push out is truly revolutionary, Even though I doubt so, I read some of the reports, it's quite rubbish already, right? Or maybe in the future there may be some AI development. Maybe the architecture changes. It's no longer just a next token prediction. They finally figure it out. They finally figure out the missing piece to like a harness. Like nowadays we have harnesses, right? To really what you call that? to compensate for the hallucination problem. Okay. Alright, so maybe hallucination really gets minimized to the extent that the AI becomes fucking good, right? And then the sales revenue explodes. Sure, then maybe we have no bubble. But right now, right, because of token maxing, right, and then my doubts about the margin, right, because of them not being included in the cost of training, right, I'm quite skeptical. So I'm still on the fence, but I move a little bit positive because I'm using it in my own enterprise use case every day at work, right? I'm like the 4th biggest burner now in tokens. So I'm very aware exactly how these tokens are being used in the market, especially in technology. But I would say that I'm much more confident in first-party use cases. For example, like Meta, right, where there is Meta works with subjective creative workloads, right, like marketing, making ads, videos, images, marketing copy. You no need to be right 100% of the time, like accounting or all this stuff, right? Serious enterprise work, right? And Meta is first-party usage, so I'm a lot more confident there. So I'm actually very happy with my current portfolio profile, where my enterprise AI exposure, which is through Amazon AWS, has been now kept at just 5%. Yeah, so a majority of my position now, 40%, is in first-party usage of AI, which is Meta. Yep. Question 18. At what age or trigger will we switch from the US equities portfolio to SG dividend stocks? I will slowly, as I approach 50 years old, I will begin looking into dividends. That will likely be the case. Yeah. Do you recommend getting just insufficient coverage as a 24-year-old or excessive coverage while premiums are still low? Thanks. Okay, this one very personal. Again, not financial advice. I'm just saying for myself. I only own personal accident, hospital medical insurance, and actually that's about it. Yeah, that's about it. I'm very, very, very simple. Yeah. So I know that there are some people, like, there's this guy, the Tree of Prosperity guy on Financial Coconut. I filmed with him before. Oh shit, what's his name? I forgot already. But that guy has zero medical insurance. He mentioned it in a video before. He said that he self-covers. So basically what he does is that he has a lot of investments in dividend stocks, everything. Then he self-covers. So if he gets sick or what, he pays for himself the fees to go to the hospital. And then he says he relies on the public health scheme. So like, public hospital, right, you can just go and then it's very cheap, right? Yeah, he relies on that. So he doesn't have private medical insurance, so he doesn't have all this whatever rider or class A or whatever shit. He goes to those like Ward C, very, very basic government subsidized hospital. So it's very, very cheap. And then so he's insuring himself, not through all these plans, right? So he doesn't pay any insurance premium at all, right? So I think this is really personal. Like, he explained it before, and I thought, okay, that makes a lot of sense, because his expectation is he's okay with being in the public hospital management scheme, right? So if he gets sick or his family gets sick, he's okay to rely on public hospitals. For my case, right, the reason why I bought hospital medical insurance, right, is a very personal story, because I've seen family members visit them, and they are based in government hospitals, right? And then they are on their dying deathbed, right? And then they are in a Ward C, and it's like fucking noisy and very, very disruptive, because the nurses keep coming into the ward every like 15 minutes to serve all the other patients in the same room. And so I realized that my auntie, for example, right, when she passed away from the liver cirrhosis, right, she really had no downtime to rest. There was no peace in the C ward, right? If you compare to a private ward where in the room at most you have only 2 people, yourself and another patient, right, you get a lot more privacy and you get better rest, and then you can spend quality time with your family. And I think that really matters a lot when you are at the end of days. But this is really, really personal. It's really, really personal, right? So whether or not to get hospital medical insurance, I think is very, very personal. But of course I'm also getting it because I think that at this point in time, my portfolio, my financials, is not so big that I can fully insure in the event of, like, touch wood, I kena cancer. What if I kena cancer, right? Then at least with my insurance I get a big lump sum payout, right? and then I get income replacement because I cannot work, right? So I don't think I'm at the stage where I can do what the 3 or dividend guy does, doing self-insuring. So for me, I still cover all this insurance with personal accident insurance and hospital medical insurance, because at the very baseline, I know touch wood, if anything happens to me, all this sudden risk of ruins, they can suddenly hit me with a couple $100,000, if kena cancer or whatever shit, I don't have to think about all these things. Yeah, I don't have to worry about all these things. So for you as 24 years old, right, I cannot comment for you. I just give you all these stories. You judge for yourself, okay? But for me, I'm doing this because I want to prevent the risk of ruin to my financials as I'm building my investment portfolio. So I'm willing to fork out this extra premiums by the side for insurance. Okay, next question. What will you do if your portfolio doesn't hit the desired CAGR after 5 years? There's a couple of things. First, I'll probably carry on working. I'll probably wait longer. I'm okay. Actually, to be very frank, I'll tell you guys something. Like, I actually consider myself semi-retired now already because I'm very happy with my current job. I have fantastic work-life balance. My work is really good. My salary is excellent. I work remotely, so I get to spend a lot of time at home with my kid, with my wife, everything. So actually, I'm really kind of semi-retired already, right? So it's even if I don't reach my portfolio, right, after not 5 years, it's 10 years. My target is 11 years actually, by 50, right? That's okay, lor. Then I wait a couple more years, it's not that a big deal for me. So there's a few things. Either I wait longer, I carry on working, not necessarily in as an employee, but maybe I find other avenues to make money, like building apps or side businesses and stuff like that. And you cannot control the market, right? What if there's really an AI bubble and it bursts, maybe 5 years from now, right? And I take longer than another 5 to 10 more years to recover, right? We cannot control that. So this whole purpose of my channel of tracking my progress towards 50 years old, right, is just a very rough guideline for me to push myself to invest capital consistently every month with my salary into my portfolio. It's just that, right? Then I can only have a very rough average gauge. But whether or not there's going to be a bubble burst or whether or not there's going to be a huge economic downturn that will thwart my portfolio plans, right, next few years, right, I cannot predict that. Yeah, so to answer your question, I'm not very hard up on hitting the end portfolio target by 50 years old at 11. No, I'm not hard up. But I use it as a rough gauge for me to allocate my monthly capital. And every 5 years, I check my desired CAGR. Have I hit it or maintained it? And so far in the last 5 years, the answer is yes. I have maintained at least 15% on a time-weighted return CAGR basis. Yeah. Next question. Do you think the conventional wisdom start investing when you are young is misleading? Young people often lack the financial means for meaningful investments. I think it's good to start early. Because sorry, let me just position somewhere here so you guys, maybe I'm scared you guys are a bit dizzy. Should I go up there? Let me wipe the frame a bit. Hold on, let me wipe the frame a bit. Shit. Sorry, let me wipe the lens, I mean. Let me wipe the lens a bit. 1 sec. Let me go up here. Maybe a better change in scenery. I have to go to a wedding pre-dinner actually. So maybe this should be the last question. 1 sec. Let me just go to a... Just walk here. Yeah, I'll end the stream. I'll end the video here. The last question. The last question is, let's see. Yeah, do you think the conventional wisdom start investing when you're young is misleading? Young people often lack the financial means for meaningful investments. I think it's good to start early, but it's misleading because investing alone, right, if the amount is not big, right, I have bad news for you guys. If the amount is not big, right, you may get a false hope that just relying on investing alone, right, you can be big. That cannot be further from the truth. Yeah, because I give you guys a really, really simple mathematics. Okay, you consider this. Let's say the S&P 500, right, makes 6% per year on average. On average, 6% per year. Okay. And let's say like a typical, I think in Singapore recently they had the median salary was about $5,000, right? Okay. So right, let's say your S&P 500 makes 6% per year. Okay. In order to match the $5,000 right monthly income, right, that the median income is in Singapore, $5,000, right? You will need a $1 million portfolio. Let me do the simple math for you, okay? Why do I say that? Let's say you have a $1 million portfolio. The S&P makes 6% per year, okay? That means that every year, on average, your $1 million portfolio is returning you $60,000 per year. Am I right? 6%, right? And then you divide it by 12 months, right? That is about $5,000 per month that the portfolio is returning you on average, okay? Which about matches the median income of Singapore, right? Singaporeans, right? So what does that mean? Your portfolio, right, needs, right, to reach at least $1 million, right, where you invest in S&P, right, before it matches the median income of Singaporeans. Which means if your portfolio is small, right, which like my portfolio is considered small, it's less than $1 million. I haven't reached that rate of $1 million at least, right? If your portfolio is less than $1 million, right, the average return you are getting, right, if you're investing in S&P 500, right, is less than the median income of Singaporeans. So let me just take a really big step to explain to you why do I even give this analogy, this example. A lot of people think that just by investing, right, you can what big. But that is false if your portfolio is still not big enough. In my opinion, at least $1 million. Because it is only after your portfolio reaches at least $1 million, right, that the average monthly returns of about $5,000, right, if you're on S&P 500 only portfolio, right, will start to match the median income of Singaporeans. Anything less than that, right, the portfolio returns does not move the needle in your net worth in your life. Not enough. So the truth is, if your portfolio is still small, if you're still under $1 million, what should your focus be? Your focus should not be on investing, Your focus should be on increasing your income. It should be on increasing your monthly salary. It should be on your side hustles, on your business, on building apps, on being a creator, on selling something. Any other income apart from investing. Because the returns on investing is still not big enough given the smaller size of your portfolio that is under $1 million to move the net worth needle in your life. You must move it through other means, right? So instead of pinning your hopes, right, on investing as the only way out, right, that you can what big, right, you should be focusing on your raising your income in your career. Because if you raise your income from $5,000 to let's say $8,000, that is more definite and controllable and faster than you waiting for the market to give you the returns that gives you the average of $8,000, right? Because $8,000, you multiply by 12, that's $96,000, right? Wow, I cannot do the math here. My brain now is broken already. You guys get the point. You do the math backwards, right? The math of you gaining your money through your career income, right, is more substantial and significant than you waiting for the market to give you higher return, right? That is until your portfolio becomes big enough, okay? So, I'm not saying don't invest when you're young. I'm saying you have to be realistic with your returns. I still think that investing when you're young is really important because remember my earlier philosophy of slow is smooth and then smooth is suddenly fast, right? You really want to start building the foundations for you to get to that $1 million. If you have the mindset that, I'm never going to get there, right, then you're never going to get there, right? But for all means and purposes, the focus should be on raising your income and keep contributing to your portfolio through means that you can control, which is the capital that you own from your salary and your bonuses and your side income and your hustles and whatever. that you plug in the portfolio, that one you can control. The moment it reaches $1 million, that's when you really start to see a huge compounding effect that measures up to the median salary of Singaporeans. So yeah, I think you should still start early with investing, but you have to be realistic and you have to also focus on other aspects of your life. Yeah. So I'm going to end the video in this episode. I'm going to film the next AMA vlog in Seoul. Probably release it like next week or following week. So guys, do check it out. Yeah. So I hope you guys enjoyed this episode, and yeah, may the long-term total compounding spirits be with you.